Okay, our streaming has begun and the recording has started.
Okay. Well, before we get started, I need to read a so pursuant to recently adopted amendments to the Illinois Open Meetings Act, included in Public Act 1010640, public bodies may, in certain circumstances, hold entirely virtual public meetings without a quorum physically present at any one location. On March 17, 2020, Village President Lawrence R. Levin issued a declaration of emergency pursuant to the authority granted by the Village Code, the Illinois Municipal Code, the Illinois Emergency Management Agency Act to address the health threat posed by the COVID-19 pandemic. On May 29, 2020, Governor Pritzker issued a disaster proclamation that declared in-person attendance at public meetings of more than 10 people at the regular public meeting location to be infeasible, in accordance with the Open Meetings Act as amended by Public Act 1010640. On June 15, 2020, President Levin executed a written determination that given the ongoing emergency associated with the COVID-19 pandemic, in-person meetings of the Village Board of Trustees, including the Finance Committee, are not practical or prudent at this time and until further notice. Last, on June 26, 2020, Governor Pritzker issued a new disaster proclamation in Executive Order 2020-43 that declared in-person attendance at public meetings of more than 50 people at the regular public meeting location to be infeasible. In accordance with the governor's most recent disaster proclamation, President Levin's declaration of emergency, and President Levin's recent determination regarding meetings of the Village Board of Trustees, President Levin determined that in-person meetings of the Finance Committee are not practical or prudent at this time and until further notice. Accordingly, this meeting of the Finance Committee is conducted virtually with members participating through the Zoom webinar platform. Village Manager Corrali is in the Village Hall conference room as required by the Open Meetings Act. Can we have roll call, Phil?
Absolutely, Trustee Vree. I will start. Chairman Vree.
Here.
Trustee Miller.
Here.
Trustee Rubin.
Here.
And for the record, I also would note that Trustee Hallwax is in attendance as well, as many other guests that Finance Director Larson will introduce in a moment.
Okay. As noted, today's Village Board meeting is being conducted as a virtual meeting via Zoom webinar software and is being audio recorded and simulcast on the Village's Facebook page in compliance with state law and as the Village continues to support social distancing to prevent the spread of COVID-19. To help facilitate this meeting, I ask each member of the Finance Committee and staff to mute your lines if you're not speaking and unmute your line when you speak to help minimize background noise. Members of the public are muted and should remain muted during the meeting. Members of the public should not share their video. As required by law, I will ask for a roll call rather than voice votes on any agenda item requiring a vote. And now I think we're on to public comment. I have another thing to read. In accordance with the supplemental rule the board approved on April 16th, 2020, here's how public comment will be taken at this meeting. The email address and telephone number designated for public comment for this meeting were published with the meeting agenda. At this time, I will ask Management Analyst Deputy Village Clerk Jordan Lester to read the public comments that were submitted prior to the meeting in compliance with the instructions that were previously published with the meeting materials. If a member of the public would like to submit a public comment during the meeting, you can email your comment to glencoemeeting@villageofglencoe.org. Comments submitted during the meeting may be read at the end of the meeting. Written comments should be limited to 400 words. Management Analyst Lester reads public comments, if any, or direction.
Thank you, Trustee Vree. We did not receive any public comments prior to tonight's meeting.
Okay, sounds good. So we can move on. So consideration of the minutes. Looking for a motion to approve.
Motion to approve.
Second.
Phil, can we have a roll call?
Trustee Vree.
Yes.
Trustee Miller.
Yes.
Trustee Rubin.
Yes.
Okay. Let's pass. So now we can move on to the beginning of what will probably be a very long meeting. So Nikki, if you want to walk us through the financial reports.
Okay, thank you. Before I get started, I just want to make sure everyone can see my screen.
Yep.
Let's see. Can you see the slides advancing? So I might be having
No.
some trouble here.
They have not advanced yet.
It's showing.
Yeah, this is the problem with multiple screens, Nikki.
Okay, hold on. Stop sharing. Let's try again.
Happy birthday, Nikki.
Thank you very much. Okay, let's try this one. Okay. Actually, let's try this one. Share. How about now?
That's better.
Yes.
All
All
right.
right. We're in business. Okay. Thank you for your patience. Just a quick overview of tonight's discussion. So we'll be talking about the July Treasurer's Report with all of the fund highlights, personnel, and cash flow projections. We'll also be talking about our community investment program, just giving the board or the committee an update. Our investment policy and portfolio, which I do want to just take a moment to introduce some folks that are on the call so everyone knows who's attending today. We do have Brian Hextall, who is our institutional portfolio manager with PMA Financial, Dean DeBias, who is our senior portfolio manager, and Eric Stoltz, who is our relationship manager. I should say, I'm sorry, I apologize, Eric, institutional sales manager. And then we also will be talking about the fire and actuarial reports, for whom we have Heidi Endorfer from Foster and Fosser. And then we'll be talking about the refunding of the Series 2012A general obligation bonds, reviewing financial policies and financial forecast assumptions. That being said, we do have a fairly large agenda, as indicated earlier. So I will be going through the Treasurer's Report rather quickly. Please stop me if you have questions. Otherwise, we'll get started. So starting with the general fund, July represents the 5th month of our stub year budget, which is actually at 50% of the year. Because of the 10-month status. Property taxes year to date are actually lower than prior year. However, they're at 70% of budget, so we're well above where we should be for this time of year. You'll see as we start to get into the cash flow projections that we did have a large influx of property tax receipts that came in July. We do believe that's the timing to some of the mortgage escrows that pay on a certain date in July. So August will be a telling month for us to determine whether or not those that are not on a mortgage escrow arrangement, if they're paying on time or if they take advantage of the county's extended deadline. So we'll keep a close eye on that in the coming month. Our income tax is lower than the prior year, but it is at 51.9% of budget. The state has restored a portion of what they had previously cut. We're still not back to that full 10% that the village is entitled to under the Constitution. However, we're better off this year than we were last year. Sales taxes, this is a very bleak month for sales tax. As you probably saw from the report, we're at about 40% of budget. This is really the first full month of the shutdown that we really start to see the impact of COVID-19. The good news is, and we'll talk about this again, when we get to cash flow projections, is that the following month does seem to be rebounding a little bit. So that is kind of good news in a bleak month. And our permit revenue continues to be lower than the prior year, but we are still at 43.2% of budget. We are still seeing a steady stream of permit revenue coming in despite the shutdown. So at this point, unfortunately, we have a lot of red on the screen. So there are quite a few of economically sensitive revenues that we will continue to monitor. As we've discussed previously with this committee, expenditures are continuing below budget, largely because of the budgetary reductions that were made as part of our discussions in April and May. So right now our expenditures are at 39.5% of budget, and we do expect that to finish the year under budget as well. In terms of the water fund, both of our main water fund revenues are higher than the prior year, which you would expect based off of rate increases. Our volumetric revenue is at 41.5% of budget. Fixed charge is right on target at 50%. At this point, we're not concerned about the volumetric revenue. We still have quite a few summer months that will be billed in the coming months. So we do expect to see that jump up here, especially with the drier weather that we've been receiving. We do expect that we'll see increased water usage due to irrigation. On the expenditure side in the water fund revenue, or in the water fund, we're at 19.9% of budget. That's largely due to the timing of the water meter replacement project that's included in this year's budget. As we start to kick that off later this month and into September, we'll start to see those expenditures rise. But again, the water fund also had expenditure reductions that will remain permanent through the end of the year. So we do still expect that to end the year below budget. In terms of the remaining fund, both the debt service fund and the capital fund are within budgetary expectations, both on the revenue and expenditure side. The MFT fund now includes the second installment of the Rebuild Illinois grant that was funneled through the Department of Revenue, or the Department of Transportation. We'll talk about this when we get to the cash flow projections, but we do expect over the next 3 years to receive over $574,000 through this grant program, which will be funneled right into our road program, our capital program. In terms of personnel, our personnel costs are slightly higher than the prior year, but they are slightly less than budget. So generally, these are performing as expected. You can see one of the cost drivers here are increases related to our collective bargaining agreements and pension costs, which are fortunately slightly offset by reductions in overtime. Cash flow projections, this is just a portion of what's included in your packet, so I apologize for the small text. As we mentioned earlier, you can see the influx of property tax revenue in July. It's slightly less than what we budgeted, slightly less than what we've seen in the prior year, but that is a healthy influx of cash for us in terms of just cash flow that's available. And then you can see here as well in the sales tax revenue, the receipt that was well below both the prior year and the budget. Those items that are highlighted in green are information that we've received based off of information that we've received from the Department of Revenue. These are disbursements that we'll be receiving in the current month, so we haven't received them yet, but we know how much those dollars are going to be. Okay. Oh, one more thing on property taxes. We have adjusted our amounts projected to more heavily weight some of our receipts. We're anticipating getting another influx in August, potentially having some folks wait until October when they can make those payments. So that will continue to adjust based off of what we see each month.
Just a quick question,
Oh,
Nikki.
sure. Mm-hmm.
If you can go back, is the budget sales tax the 246,000?
Yes. So this is a complication that we encountered with our new financial software. The budget is projected based off of what happens in the prior year. And last year, and I apologize because this was my oversight, and now we're too far into the year to correct it. Last year, there was an audit adjustment to reverse an accrual. So that is how the budget projected. So it looks a little funny That's not actually what happened last year, which is why we have kind of this prior year budget. So for the month of August, it's not ideal, but at least we can have a comparison from prior year to the current year. Going forward, we've talked to our software consultants and we know how to fix this so it doesn't happen again. So this is kind of a growing pain of a new system.
And did we budget for 100,000 less in sales tax this year than last year? Is that?
We did budget for less. In total, I don't know if you can see what's happening here, but if we adjust what actually happened on a cash basis, it will change our overall budget. But you are correct, we did budget for slightly less based off of some vacancies that we have in town, understanding that that would not all be replaced within the year. So we did budget down in sales taxes, correct?
Okay.
Good question. Okay, just a few other items of note. We did receive, unfortunately, bad news from the Department of Revenue. They've released projections of what the state will be sharing in terms of personal property replacement tax, and they are going to be reducing that by approximately 17%. So we did adjust our outlying projections for the state's fiscal year 2021, which goes from July of this year through June of 2021. So that is part of the reason for the projected impact going up. The good news is our use tax remains stable. So we are keeping that number relatively stable. It would be nice if we could see an impact from all of the online sales, but unfortunately, as we've discussed at prior meetings, it doesn't appear that the state is going to be sharing that with us, any additional. Parking fees remain bleak as a reflection of the shutdown and folks working remotely. We're just not seeing those commuter lots being utilized. So that remains to be seen what we will see from that the remainder of the year. Our vehicle license revenues have rebounded quite a bit. We're not at where we were last year, but our social media posts and our web pushes to residents to get in to comply with that requirement have been successful. And we've been able to get within fairly close of where we were last year. And then lastly, just talking about total impact of all of these items on the general fund, we are looking at a potential revenue loss of approximately $2.2 million this year. That includes all of the assumptions that we had discussed in prior months in terms of reduced receipts of income tax, sales taxes, potential delays in some of our revenue as well. We did, as a reminder, decide to reduce the budget by $2.4 million. So we're still within that window of what we've adjusted to, but this is something that we'll continue to watch very closely in case we do need to make any additional cuts in the current year. In terms of expenditures, as we discussed, we just mentioned earlier, we do anticipate that our expenditures will end the year below budget based off of those budgetary cuts that had been made. In the water fund has remained relatively stable. One item I would like to point out in terms of this cash flow projection is that our water bond sale did close on July 8th. So we do have that scaled down bond issue of proceeds of $3 million. Whew, we'd be in trouble if it was 3,000. $3 million has settled, and that's now sitting in the water fund ready to be expended. We do expect expenditures to start picking up here, especially at the end of August. We'll start to replace some of our water meters. We're going to start with a test set of meters and then also starting to kick off our fall water main replacement project. So we'll start to see, especially in September, October, those expenditures starting to kick up. So we might need to adjust these figures as we see how August plays out. Okay. The MFT fund activity remains relatively unmarkable. There were not any large expenditures budgeted in the current year in MFT, but I do want to point out here the second installment of the Rebuild Illinois funds. So total for this stub year, we received $191,000, and this is what we can expect to see in the next 2 calendar years as well. Okay, and then in summary, the total financial impact of all of these items together, the good news is all of our funds are still projected to end the fiscal year at or above their fund balance targets. So despite the revenue loss, we're still in a financial position that's within policy. And then at the end of the financial report, we have included updated charts for rates of change, the first of which being sales taxes. So this gives you an idea of the 12-month rolling total and the 12-month rate of change since 2013. And you can see, obviously, the large dip here in the current month. So we do expect to see that jump up a little bit in the coming month, and we're hoping to see that number continue to recover as we move through the phases of reopening. In terms of property taxes, this chart may look a little different from what's in your packet. We did correct this. We had kind of a large spike here that was not right. So now the adjusted graph does show the 12-month rolling total with that steady upward trend, essentially moving with CPI and the rate of change that's relatively stable. So even though this is a slightly erratic revenue that's received throughout the year, as a total, as a whole, property taxes are relatively stable revenue. And lastly, use taxes. You can see that steady increase up. We do expect to see that kind of level off, which you can see with the rates of change here. So we're hoping that this will remain a relatively stable revenue for the village as we move forward. And at this point, I'm happy to answer any questions on the financial report.
I had a question going back to the projections for
Sure.
the revenue, that chart. I'm trying to reconcile the 2.2 million that I know we're projecting, we're going to be short on revenue, with the chart itself and the totals versus budgets in the right-hand column.
Okay.
So, yeah. So when I start looking at that, and I see a difference of, real estate property tax that at the end of the year is a relatively modest amount, but sales tax, I know we're projecting appropriately at least a 30% decrease in revenue, but I'm looking at 147 versus 1,491,000. That's not a 30% decrease.
And
is that because of that August negative instead of what it should have been a positive, probably of almost 200,000? Is that where the like $450,000 delta is?
some of that is, but it's also that these numbers are all actual and not all of these were 30% decreases.
Oh, sure.
So this math won't be perfect because it's really just these numbers, the outlying numbers that we don't know yet. Those are being projected at 30% less. So I guess the better way for me to explain that is we don't expect sales tax as a whole to be 30% under budget. We are expecting the remaining months of the fiscal year to be 30% under budget.
All right. Well, then taking that into account, what are the 3 biggest contributors to a $2.2 million revenue decrease?
Some of that.
Clearly, sales tax has got to be one of them.
Sales tax is a contributor. Some of it is building permits. Some of it is utility tax. Income tax is a small portion of it. It's really bits and pieces across the entire projection.
Okay.
Yes.
Because I looked at the chart and then I was trying to get to 2.2 and I didn't take a calculator out, but I was trying to figure out how that worked.
And in future reports, we can kind of highlight where that difference is
Okay.
and how we get there.
To Gary's point, just very quick sum totaling all of this stuff, it's 700 grand or so. So there's 1.5 million elsewhere falling short.
And again, I apologize. We can look into that and we can provide the detail of it, of how we're getting to that number. But,
Okay.
yeah.
Thank you.
No problem. Are there any other questions?
Okay. If no other questions, should we move on to the CIP?
Sure.
So just a quick update on this month's CIP. I think Nikki's, there we go. Even though it's a little too small to see, but I know you've got a larger spreadsheet of that in your packet today. There are a couple items coming to the village board for your consideration this Thursday. A couple of them are a change order amendment to the engineering agreement with HLR for Tudor Court Streetscape in the amount of $26,995. Just to note on the Tudor Court, it is now scheduled to be completed in September. There were some delays on materials being delivered. In addition, the board will be asked to consider a contract with Morrow Sewer Construction for the 2020 water main replacement improvement project for $710,564 and an agreement with Burns and McDonnell for construction engineering services for a total cost not to exceed $43,000. Currently, just an update, the commuter lot lighting project is complete. That was just completed a few weeks ago, and I believe that was it. This concludes my report on this update. Do you have any questions?
I don't think so. Does anybody have any questions? Okay, if none, so are we moving on now to the investment policy?
Correct.
Okay.
Perfect. So as I mentioned, we're joined this evening by our team from PMA Asset Management. As the committee may recall, in June, we did present some proposed updates and changes to our existing investment policy. As a result of that discussion, staff and PMA got together on several items that required follow-up, including feedback from the committee on the proposed changes to the policy, additional information on PMA's investment selection process and the process that they use to evaluate some of our investments, and also just a current update on the status of the village's portfolio given the volatile nature of the market right now. So without further ado, I will turn it over to PMA.
Oh, Nikki, Eric's going to get us start. Oh, never mind. That's what I was going to ask. All right.
Thank you, Nikki. Yeah, I'm just going to start us off here. I know we already did instructions, but just again, really quickly, Brian Hextall's on the line with us here. He's the portfolio manager for the account of the village. We also have on the line Dean DeBias. He is another one of our senior portfolio managers, and he is the resident expert on agency mortgage-backed securities. I know there were a lot of questions on those the last meetings that we had. So we brought him on board today just in case there's any further questions. And then there's me, of course, and I'm, like Nikki said, relationship manager and part of the business development team here in Illinois. So we can skip to the next. So again, Nikki had also mentioned this a little bit too. The last time we met, we kind of discussed our different the investment policy updates that were kind of in line with the desired risk profile for the village, and then we also talked about adding an ESG component as well. So we're going to talk about that a little bit more today. We also gave you kind of the walkthrough of our overall investment process. So as we talk about here, as this kind of indicates, this page, we really are. So PMA is a firm that works exclusively with the public sector. So our entire focus, again, is built around the Illinois Public Fund Investment Statute. So everything that we do is guided by that overall structure. Everything that we do is also informed by in-depth research. Everything we do is internal, it's independent research. We do it on our own. We do it by individual security selection. And that's how we do it as well. Our internal risk controls also guide our overall strategy. We have the systems in place and the process in place through our investment guidelines in order to be able to service the village. And then when following all those processes, that brings us to a diversified portfolio solution that we really believe creates long-term positive and sustainable results for the village's portfolio. So next, Brian will be taking over as well.
All right, thanks, Eric, and thank you again for everybody's time. As Nikki mentioned, we've had a couple of good conversations following our meeting in June. So, I'm going to go through this fairly quickly because I don't know that everyone wants to hear the long version of these next few slides. But, what I really wanted to follow up on is there were a number of questions during our last meeting is, what's our process? What sort of tools do we have in place? How do we think about all these different investments? And, I'll say this is one of our standard slides, but it is because it's very true. And our process starts with research. That's number one. And it starts with that top-down look, what's happening in the economy and the markets. In June, we shared with you some of our thoughts before we got into the portfolio on, what was happening in the economy and what our expectations are. That research is also a lot of what we call bottom-up research as well, understanding each individual issuer and each individual security that we're buying. And, all of that research helps come together to help us think about what are expected returns across sectors. And, we put that together with the needs that are unique to each one of our clients, and we build customized portfolios. So we're thinking about relative value, we're thinking about client need, and we're selecting securities that we think are going to add value. Implementation on this wheel is really talking about best execution. We're out looking across the market, identifying the securities that are going to provide, the best price and hopefully the best returns going forward. And finally, we measure that. We're looking at this every day. How are returns? We're thinking about individual portfolio characteristics like yield, like ratings, that sort of information. And, we're looking at that, we're providing it through our online reporting platform. So it's a super transparent process, and all that measurement leads right back into research and expected returns again. So, it's a very thorough process, and it's something that we are definitely doing on a day-to-day basis and thinking about for each of our client portfolios. So if we flip over to the next slide, it just dives a little bit deeper into research. And, just to hit the highlight on this screen is that, research truly is foundational to PMA. The company was founded as doing research, credit research work for public entities in the early 1980s. Our business has expanded greatly since then into a full service investment provider. But it really is at the foundation of everything we do. It starts with credit research, and whether we're analyzing a company, a corporation, or we're buying a municipal security, so we're analyzing that. Or maybe we're thinking about an asset-backed security like a mortgage-backed security. The same sorts of things are what we're thinking about. Obvious stuff like ratio analysis, we're thinking about what's the capital structure of a company, debt to equity sorts of things. What are earnings? How are they trending? How strong is liquidity, and what are the trends there? So, but then it's also deeper things like how consistent is management in their approach, and what's happening in a particular industry. You think about an industry like the auto industry, for example, right now, that's going through a lot of changes. And speaking of those changes, I suppose ESG, environmental, social, and governance concerns, is required under the Public Funds Investment Act. We're thinking about sustainability issues. And always just thinking about risks. As bond investors, you're always thinking about what's changing, where do my risks lie, because our upside is limited. We're worried, we're not worried, but we're concerned, and we're thinking about how do we best manage the risks that we see in our portfolios. So with that, on the next slide, we've got a great team in place. You had a chance to meet our Chief Investment Officer in June. That was John Huber. On the call today, we'll hear a little bit in just a moment from Dean, who heads our rates team. So he's really focused on government securities, government agencies, including those agency mortgage-backed securities. Our credit team, headed by Jeanette Parr. You can see she's got a large team reporting to her, thinking about all that credit work that I just got talking about. So, really what we have here is a great group of people who are really committed to serving our public funds clients. And our team is aided by access to really industry-leading systems and tools. And I'm going to turn it over to Dean on the next slide to talk a little bit more about the systems that we have in place.
Good evening. Can everyone hear me?
Yes.
Okay, good. Yes, good evening. Again, my name is Dean Tobias. I'm a PM at PMA, focused principally on mortgage and asset-backed securities. We use, to generate the transparency and information that Brian spoke of earlier, we use a variety of different systems across our platform that gives us a tremendous amount of information and transparency into the investments we purchase for our clients. And starting from left to right, or more specifically in the middle there, the first and probably the most powerful is Bloomberg and Bloomberg AIM. That gives us a whole host of features within the world of mortgage analytics. It provides us structure, so we understand the structures that we're purchasing, the cash flow dynamics of those, not only in a stable environment, but in up and down interest rate environments, to the extent interest rates impact those cash flows. It allows us in-depth analysis, ultimately down to the loan level. We can look at the income generation capabilities at the loan level. It provides us credit support as it relates to the availability of the structures to absorb any losses to the extent that it may be a loss-bearing security, which isn't applicable necessarily to your portfolio, but to the extent that it were to exist. It integrates compliance into those. So to the extent that the village has either state-specific compliance rules or anything unique that you would want, it fully integrates any and all of the compliance requirements that you have specific to your needs, and interest rate management and asset liability management needs. And in addition to that, we have additional overlays for mortgages. One of the systems we use giving us property sort of valuation and metrics would be a system that Fannie Mae provides called Dust Disclose, where we can look down to the loan level, down to the property level, literally drilling down to the property and looking at the cash flow generations of that commercial loan. In that instance, these are properties that are income-producing properties. They are, for all intents and purposes, think of them as apartments, or we can look at the income generation, the property valuations, and more importantly, they're updated on a quarterly basis, so we understand how they change through time and whether any of those changes would necessitate any actions to be taken on our part. Addition to that, we have Clearwater Analytics. That is a post-trade compliance, so any of those changes were to occur and impact on an ongoing basis any of those compliance rules, we can take action on a post-trade basis as well. So all of that's integrated in your portfolio. We understand how the time zero impacts are and how they change through time. So all of that's integrated into the systems we use, up to and including any accounting-related impacts that may be associated with the portfolio. So I sort of rushed through that. I'd be happy to answer any specific questions you may have with respect to our systems and their abilities and capabilities. So Brian, anything else did you want me to touch on?
No. I'll just point out that we also did include an appendix that we don't plan to go through unless there were any specific questions. But at your leisure, we provide some additional information on the systems that Dean was just referring to, as well as some additional background information on agency mortgage-backed securities. So, reading materials for your
level,
sleeping.
Loan level and property level analytics, all sort of rolled into one and integrated up to and including compliance, any specific nuances that you may have with respect to your investment policies and parameters, all integrated into a system or systems, as the case may be.
Yeah, with that, Nikki, I think we can move on to the portfolio update. Since we just spoke 2 months ago, we thought we would boil this down and keep it pretty simple at one slide. I'll point out that the portfolio composition is really about the same as it was 2 months ago. I think the good news here is that on the village of Glencoe's emblem there is blocking a little bit of the numbers, but what you can see in the gross returns here is since inception, just last October, we have returns that are up over 4%. You can see on a quarter to date basis. So we ran this as of August 5th. So we've got a little over a month's worth of data, really strong returns in July and early August. Even the second quarter was very strong, 0.7%. I mean, you annualize that out, that's going to be a huge return. Obviously, we're not going to be able to, keep that sort of a rate of return going here over a long period of time. But, the bottom line here is that outside of a turbulent March, returns have been quite strong in the portfolio. If we could see in the bottom right corner there, we are slightly lagging our benchmark, and that's largely due to the volatility that we saw in March, but we're catching up very quickly here. And again, I think the really positive news here is that the portfolio is up over 4% since we started managing it last October. So
Brian, I have a question.
Yes.
You may not know offhand, but do you know how the portfolio did just in March, just to get a sense of, everything snapped back so quickly that it was, it's all kind of buried in here, but just to get a sense of what the volatility on this was?
Yeah, absolutely. And I happen to have it pretty handy right here. So if you give me just one moment, where are we at here? March 1st. go. So it
Even March and
looks,
April, just both to see.
oh, give me once, I'm almost there. Okay, so for the month of March, so, you know, it's funny. So returns were actually very strong. The month of March had returns of positive 0.84%. It's just that the index return was up almost 1.7%. So, you know, we've got an index that's comprised of treasuries and agency bullets for the most part, which for our public entity clients is really a good high quality barometer of where the market is going under normal times. But when you have a flight to quality and the Fed cutting rates by 150 basis points all within the course of about 2 weeks, you know, things don't track together as much as they would normally. So again, it was a positive month. It was just a month that trailed the index by about 90 basis points.
I'm just curious. I mean, because I just don't know how CMBSs work in an environment like that.
Yeah, I mean, basically they're going to trade a little bit wider, certainly of just an agency bullet security, but they're also very quick to recover. So as we move from March, where we trailed the benchmark by 90 basis points, if I jump ahead here 1 month and look at April, we had total returns. They were lower because interest rates weren't moving down anymore. They were positive 0.26%, but beating the index that was basically 0.1. So we beat the index by 15 basis points in April. You know, as soon as the market started recovering, you know, one of the first asset classes to improve is going to be the agency type securities.
Okay.
Dean, do you have something else to add there?
No, I think you hit it right on the nose, Brian. Basically, you can think of any non-treasury security when rates drop precipitously can't possibly keep up with treasury rates because everybody is going to basically invest in the highest quality asset when there's significant uncertainty. And to Brian's point, as you know, the future becomes clearer, they will then move out of treasuries into the next highest quality asset, which are agencies and similar, you know, very, very high quality assets, which the village is invested in. But when you have such a massive movement, no non-treasury security can keep up with treasuries.
Yeah, and I was just wondering if the CMBS is actually went the opposite direction, if the spreads widen so much that rates.
Typically, our agency securities will widen, but directionally they will move consistent with treasuries. But they will widen, yes.
Okay.
But again, they still are agency securities, so they have the creditworthiness of an agency security.
Okay. Sounds good.
That's a quick question to Brian. Just want to clarify something. You said that we underperformed because of the volatility in March, and I guess I'm trying to wrap my head around that. Is maybe a different way to phrase that the index, we're holding less treasury securities than the index due to the volatility. Treasury securities had higher performing than, say, the assets that we hold. Is that what you're saying?
Yeah, you're basically saying exactly right. The volatility that I'm referring to is the decrease in interest rates. So as Dean was just describing, when you have interest rates moving real significantly like that, other sectors of the market really just can't keep up. So
okay.
Yes.
The next question is: Do you have a slide that shows net of fees instead of gross?
I don't have that with me here, but here I'll actually.
Fine. I would just think in the future, maybe throw that in the appendix. It'd be nice to see what we're getting for what we're paying for.
Right.
Thanks.
Absolutely. Nikki, if you want to move on to the next slide, unless there's any other questions, really the third thing we wanted to touch on today was those changes to the investment policy. So when we last met, I think some of the requests were, we made, it was as I mentioned last time, the village really had a good investment policy. We made some tweaks to it when we met in June to kind of just shore up a couple of items that maybe just needed some updating or that sort of a thing, but in a good position. I think it became fairly clear in our meeting last time that the village was looking for a little deeper dive into the policy to address even more directly some language around diversification, around ratings requirements, around maturity limitations, and then also provide some additional language around that new sustainable investing law that's in place. So we kind of gave some more meat to the policy in that area. So I think we addressed all of those. Again, we had some good conversations with staff in July to go over those changes. I don't know if you have that handy, Nikki. I think the most notable was we wanted to put some restrictions around the agency mortgage-backed securities. So we kind of took a look at that in parts, recognizing that there's some differences in risks between residential mortgage-backed securities and commercial mortgage-backed. Again, as investment professionals, we talk about risk all the time. Everything's relative. These are all relatively low risk investments, but given the fact that they have different characteristics, we felt like sorting those out would be useful from a risk management perspective. Nikki, are you trying? There we go.
Yeah. I was just going to say, I can't change this without losing, but it is included in the packet, the proposed red line changes. It's both in red line and a clean version.
Yeah.
And the chart in specific that Brian is mentioning is on packet page 71. That indicates the maximum portfolio investment exposure in each of those categories.
I had a quick question about that. Municipal securities, I noted were a maximum portfolio investment exposure of 50%, which concerned me, although then I saw that we've added rating requirements. I'm just wondering, and some of the other language has been added about the municipal securities, is why, it seemed like there's less restriction, so to speak. Corporate obligations with 3 highest classifications are a third, but municipals are 50. Why favoring municipals?
I think when we're investing in municipal securities, we're either thinking about a general obligation of a city, state, village, county, school district, that sort of thing, or we're thinking about essential revenue, water and sewer type bonds. So when you look at the historical loss rates on municipal securities, particularly over relatively short periods of time, inside 5 years, like the village's portfolio here, the loss rates are extraordinarily low. I mean, they're very low across all these asset classes when you think inside 5 years, but municipal securities have performed very, very well over time. And like everything else, we're diversifying, we're holding, we're thinking about that diversification across states, across, the backing of those loans, be it, taxes, real estate taxes versus sales taxes and other things. So, I think that having a little more, potentially having a little more exposure to municipal securities makes sense just from a pure credit history perspective.
I have a question. With respect to the way the policy reads, we could be investing in bonds of the state of Illinois. I would assume, under the policy, is that possible that we would ever buy a bond of the state of Illinois?
Um, maybe technically possible, but I'll tell you, we've not bought a state of Illinois bond in about five years or more since the, not only the credit rating started acting, but it became just very apparent that the budget situation and the financial health of the state was moving in the wrong direction. So again, that's where, we're always as managers going to be taking a more conservative route than, it's not our goal to press right up against all these limits. We're looking to, manage risk, kind of going back to my earlier comment that, unlike equity managers where the upside is unlimited and, we've got the FANG stocks up, almost 100% this year, Amazon's and Google's all doing so well. As bond investors, we get our coupon, and that's all the upside really is. So it's about managing risk, and we think long and hard before we buy any bond about those risks.
Right.
And Brian, if I may just add to that, under the current policy with the credit rating requirement, unfortunately, it would not be possible for us to even buy a state bond right now because we are requiring that any municipal security must be in the three highest classifications. So Brian, unless I'm mistaken, unless the state makes a miraculous recovery on their credit rating, right now they would not be able to buy that under our current policy.
I was going to chime in. It's single A minus or higher per policy.
Yeah, and the state of Illinois is now down to the triple B. So yeah, I was forgetting the state statute allows through triple B, but we put in single A here. And again, not that we buy triple B anyways, which is why we changed it to single A for this.
Yes, that's more the answer I would have expected if somebody said, could you buy California or Illinois bonds? Because I would think either of those are exceptionally high risk. The other question I had, I assume we don't own any bonds that have as collateral real estate, commercial or other real estate in a major city, or
the commercial mortgage-backed securities that are owned in the portfolio, first and foremost, are all agency-backed securities. You have Fannie Mae and Freddie Mac behind them, but they're also all multifamily loans. They're all apartment loans. I think maybe a couple of healthcare in there, but vast majority are multifamily apartment loans. So we don't have exposure to things like office space, hotels, other industrial type properties. None of that.
Have you all been monitoring and looking at the risk on multifamily in cities like Chicago or Portland or that sort of thing in terms of how you look at this? Because one of the great concerns of economists, of which I'm one, is that in our major cities right now and the suburbs of major cities, multifamily dwellings may suddenly have changed from being equal to gold to being a disaster if we see flight.
I mean, we're certainly watching those headlines, and there's lots of discussion about people moving to the suburbs, out of cities. We'll see to what extent that plays itself out. Decisions like that don't tend to happen overnight. But Dean, I'll hand it back to you to maybe provide a little more flavor there.
Yeah, there is a belief that there will be exodus out of urban areas generically into the suburbs. Obviously, with 5 months or thereabouts under our belts, we haven't seen that as an overall theme, but it is a concern that we're watching. Right now, a lot of the urban areas are still pretty strong, New York included, Chicago included. So until we obviously see a beginning of that. It's hard to prognosticate the future.
Thank you.
Yeah, and I'm sorry, one additional point of clarification. California is a AA rated state. So that would be allowable under your existing policy.
I would only express my hope that you're smart enough not to be fooled by that.
Yeah, I mean, I guess we should respond to that. You know, it's, I think, what is it, Dean, the fifth biggest economy in the world? If you looked at the state of California as a kind of its GDP alone relative to the world, I mean, very diversified. You know, certainly there are some you know, risks around things like, you know, kind of natural disasters, fires, earthquakes, this sort of thing. There's definitely some political risk. We're very closely watching what's happening in the on the West Coast and in some major cities. But, you know, again, there's nothing there that, you know, given the depth and the breadth of the economy of the state of California, you know, we do feel comfortable with that as a name. I mean, if you know, again, we work for our clients, so if there was ever a directive to, you know, do something very specific, we can do that. But I just wanted to share our thoughts that, you know, at this time we do remain comfortable with California as an issuer.
I won't bore you now with the 47 reasons why, as an economist, I think that's foolhardy, but I may talk to Nikki about whether we should add to your list of things that you don't put money at risk in California. Yeah.
We want to talk about it in the whole group. I don't have the same concerns you do, Larry.
Right. I don't think we need to address it now, but I just do express a major concern about them.
All right. Noted. Thank you. And with that, I mean, if there's no other questions, I believe that concludes our remarks.
Okay. Any other questions by anyone?
Nikki, real quick, this updated policy will come back then to the village board for approval in September. Is that the expectation?
Correct. So understanding, we wanted feedback from the committee if there were any proposed changes to what had been laid out for you this evening. We were going to incorporate those, but our plan is to bring this back to the village board as a whole at the September meeting for formal approval. If nothing else, we are required to adopt some form of the sustainable investment piece because of the change in legislation. So this is a good time for us to update the policy as a whole. And we're happy to take if there are any other questions or any other feedback on the red line policy as was provided to you.
Okay. Thank you, everyone. Thanks for the presentation. We've done a couple of these now. It's appreciated. So thank you.
Right. Thank you very much. Have a good rest of the meeting, everybody.
Thank you.
Thank you.
Thank you.
So now we're moving on to the actuarial reports.
Correct. Thank you. Okay, so moving on. As noted in your packet, each year the village engages our private actuary, Foster & Foster, to conduct an analysis of each of our pension funds to determine our required contribution to each pension fund. I don't want to steal Heidi's thunder, but just a quick snapshot of our actuarial results for the year. Our police pension fund, which is by far the largest in volume and activity, closed this year with $37.3 million in assets and a 4.5% investment return. Unfortunately, that is shy of our investment target. But as Heidi will explain to you shortly, we're very pleased with a positive return given the volatility in the market in that March, February timeframe. And understanding that our required contribution is increasing quite a bit. We'll be going through the reports in much more detail to explain why that had happened. On the fire pension side, the committee may recall that we are funding this pension fund on a pay-as-you-go basis. We only have one remaining dependent that is paid out of this fund. It's approximately $48,000 a year, and we do not have any new enrollees in this fund. So at some point, this fund will cease to exist. So at this point, I'd like to turn it over to Heidi Andorfer from Foster & Foster. Heidi's going to go through the report, kind of highlights, and she can answer any detailed questions that you have on the contributions. I'm going to stop sharing my screen because, whoops, I think, here we go. Heidi's going to share hers and go through the report.
Hi, thank you for having me here tonight and allowing me to go through the results of the report with you. I am going to be focusing on the police report because, as Nikki mentioned, you do fund the fire on a pay-as-you-go. There's one participant left, and that's about a $48,000 annual payment. So we're going to focus on the police report, which has much more interesting year-over-year numbers to show. Let me get that up on the screen for you. Just need to find. Let me find where I have it up here. There we go. Okay. Can everybody see the numbers here?
We can, Heidi, thank you.
Wonderful. Okay, so this is our summary page of the report, sort of our bottom line on top. You could see on the right-hand side of the page will be last year's numbers. This left-hand column will be the calculations determined as of this valuation date of 3/1/2020. And you can see that was about a 15% year-over-year increase. The primary reasons for that increase were a few things. If you recall back in December of 2019, they did pass legislation that increased benefits for Tier 2 participants. About 50% of your active participants are in Tier 2. And so those increases are reflected in this valuation for the first time. So that did increase the year-over-year contribution as we would expect. Those changes, by the way, for Tier 2, there were three main ones. One of them was related to spousal benefits, and it was basically equalizing the benefits that Tier 1 already was getting for spousal benefits. Tier 2 now gets similar benefits. That wasn't the case before. The second change was really more proactive so that there wouldn't be problems in the future with respect to safe harbor rules. And that change related to how the pension would increase in terms of the salary included. So there is a pensionable pay cap for Tier 2, and that is increased annually now by CPI-U. It was annually increased by 50% of CPI-U before. So you could see in the future how using only 50% of effectively inflation would cause problems with safe harbor rules in the future. So that was removed, which did increase benefits because it allows more pay into the formula. And the third change related to the final average salary. This one was really the most impactful, increased benefits the most. The averaging period for the benefit calculation was reduced from 96 of the last 120 months to 48 of the last 60 months. So it's a shorter time frame, more current pay, which is generally going to be higher. So there's higher pay now being introduced into the benefit formula. If we look at other things that increased the contribution year over year, a couple of things were, there was some unfavorable experience, and we'll get into some more detail on that. And then lastly, you do employ a payroll growth assumption, which I'll describe it in a bit more detail as well. But the natural thing that happens with the payroll growth assumption is that every year your contribution is basically guaranteed to go up, all else being equal. If I look at some of the experience listed here on this page, you can see that the plan did experience that 4.5% return relative to the assumption of 6.5%. So we were about 2% lower. That is on an actual basis. It's smoothed. If I was to look at your market return, it was a bit higher. It was 5%. We do smooth returns over a 5-year period to decrease as much volatility as we can to these annual contribution numbers so that you're not seeing numbers that jump around as much as they would if we used market value returns. If you look at other funds around the same time period, I mean, this has to be the most volatile few months that we've ever seen with valuation dates. So we had plans that had January 1st valuation dates that did quite well. Their return for the year was 17, 19%, something much higher. As we approached, April 30th, which we have a lot of valuations in that time frame, returns were the opposite. We saw returns from 0% down to -7%. So you were somewhere in the middle of that, as we would expect, given your valuation date of February or of March 1st, basically. So it's been quite a volatile few months, as we're all well aware. If we turn to page, I'm going to flip you to page 7 here. So let me just move you over here. This gets into some of the details of the valuation. Specifically, we do have multiple columns here shown now. So again, the far right side is going to show you last year's results. This middle column is going to show you what the results would have been had those benefit changes not been implemented. And then the final column is the new benefits, including the tier 2 benefits that were legislated in December of 2019. When we look at the headcounts of the valuation, you can see the active headcount did go up. Now remember, we're always doing the valuation as of a snapshot valuation date. So headcounts obviously are volatile throughout the year, as are assets and all of the other numbers, but we do take the numbers as they exist on the valuation date. So as of that date, in that point in time, you did see one extra active headcount. That was generated by the fact that you had 2 retirees happen between the 2 valuation dates, and then added 3 new actives to replace those 2 retirees in that time frame. Your retiree count went up by 2, as you can see here. We had some change to the beneficiary counts. We had a couple of dependents come in, and 1 beneficiary was deceased. So there's always going to be some changes in these numbers, not too much activity in your fund year over year. The biggest one being those 2 retirees from the actives. That was more retirees than we expected, which also resulted in a bit of a loss and an increase in contribution as well. If we look down here to section B in the assets, you can see that the actuarial value of assets is actually higher than market value. Remember, for the sake of these calculations, we do use actuarial value of assets in the calculations. Market value can be quite volatile, as we illustrated earlier with those valuation dates. And we do smooth asset returns over a 5-year period. So we smooth any gains and losses that are either above or below the 6.5% expected return of the fund over a 5-year period. The last couple of years have been losses. And so as a result, you're not reflecting all of the losses at this point in time, and therefore the actual value is higher than the market value. That's going to be true for the next couple of years, assuming that you continue to, if you were to meet that 6.5% return.
Can I ask a quick question?
Absolutely.
If we used, instead of a 6.5% return for actuarial value, if we used 3%, would then we be above the actuarial value?
So you would have had a gain instead of a loss on an asset smoothing basis. But if you look at the very bottom number here, these liabilities, this $74 million number, I would be coming at you with a number probably over $100,000 at that point in time. And therefore you would have a lot more liability to compare to those assets. It wouldn't really change the asset values. I mean, in the end, the assets are always going to revolve around market value. But the liabilities are highly, so sorry about that. Unfortunately, working from home. If you drop the interest rate, it will increase the liabilities significantly.
Okay. It's just funny that you carry a value based on a number that you just say this is what it'll be, and then you base everything else off of
we do. So we base it, it's not a guess. We do look at actual information received by your investment advisors to see what they expect from a long-term investment portfolio based on your target allocations and such. So there's a little bit of science behind it, but it is sort of an annual something that we review, the interest rate. I'd say 6.5% for a fund of your size. I would put that on the average to conservative end of things. We see many funds that are closer to 6.75, which would decrease liabilities, but we always like to see things on the conservative end where we can to make sure that we're prudently funding the plan. And in your situation, I feel that that's the case. I said for the last couple of years you've had losses. The couple of years prior to that, you had planned gains, so you were exceeding expectations. So that's bound to happen. You're never going to hit. It's rare that you would actually hit 6.5% in any given year. But our assumption is a long-term assumption. So we're saying over the life of this fund, we think 6.5% annually is a reasonable average.
That's fine. Funny way, but anyway.
Well, unfortunately, with actual results, they're self-correcting annually. So to the extent that you were missing every year, you end up with more liabilities that need to be funded through, other sources of contribution. So it comes back to you eventually. It's a matter of if you're assuming something not conservative enough, you're sort of effectively kicking the can. The benefits will be paid regardless, and that will influence the contribution eventually.
Have you looked, just out of curiosity, and do you have a thought about once this pension is consolidated, so all of the 666 pension funds, police pension funds in Illinois are consolidated, the expectation is over the next 5 years that will then change and dramatically increase the rate of return once they actually get there and the investments can get redone to be the way they would be with that size of an investment fund. Have you looked at all what the impact of that might look like on our pension fund?
We haven't.
Our 5-year average.
Yeah, we haven't looked at your fund specifically, but in general, we're thinking with consolidation that the rate of return will be higher on average for the funds, because the idea being, one, the consolidation has also loosened some of the investment restrictions that the fund is currently subject to. So right now there's pretty strict rules around how the fund has to invest, and there's certain investments that are restricted to the fund. Some of those rules loosen up once the fund is consolidated, giving more investment options available to the investment advisors. Obviously, the idea of consolidation is to decrease the investment fees related to the funds. So that should also contribute to the ongoing investment return of the fund. I could tell you that, largely the consolidated funds are looking to IMRF as a sample of what to do. And right now, IMRF is assuming 7.25. It wouldn't be surprising to me if the consolidated fund moves their expectation of long-term returns to 7.25. I don't think they'd move higher than that, and it wouldn't surprise me either if they stayed a little bit shy of that and were closer to 7%. But I would certainly expect with the consolidation that they would eventually move that long-term expectation up, and therefore liabilities would come down as a result of that.
Right, so we would be actually hitting much closer to your 6.5 target then.
Absolutely.
Actually, hopefully exceeding it.
Hopefully that's the case once things are consolidated. Now there will be a cost to consolidation. So in the short term, I wouldn't expect any higher returns as a result of that. There's going to be some cost to getting the funds shifted over, and administrative costs aren't certainly going to be lower in the short term, but eventually the idea is being consolidated on a long-term basis will reduce administrative expenses, investment expenses, and ultimately allow for more investment options and greater return.
Right, that's why we think it's going to take at least 5 years for us to hit that point.
I think you're right. I think that's the case, and we're thinking along those same lines.
Okay.
Okay. Good questions. So let's move to I'm going to move you one more page to page 8 here and continue to look at the liabilities here. Again, focusing on that that left-hand column for this year's numbers. A couple numbers on this page that are important to note. There's a funded ratio at the bottom that shows you how well funded the plan is. That funded ratio is determined by taking the smooth value of assets and dividing it by the liability. So that tells you how much of the accrued liability is covered, already paid for effectively by assets. Total actual accrued liability represents the value that's already been earned in the fund to date. So you take all of your inactives and then your actives based on service that they've already earned in the fund and calculate the liability that would be attributed to that. And that's what the actual accrued liability is equal to. We do calculate this a little bit differently than the Department of Insurance. We use an entry age normal approach, which smooths things out on a more level basis on a long term, until up to retirement age, which can be a little bit more conservative and certainly less volatile than the Department of Insurance methodology, which uses a projected unit credit method. This number, the liability number, is the 64.5 million effectively. Comparing that to the actuarial value of assets, that puts your funded status at just shy of 58%. Had they not implemented the tier 2 changes, you would have been over 58%. But we did see that come down a little bit due to the increased liabilities, due to the, the returns not meeting the 6.5% expectation last year. The other number I want to point out on this page is this total normal cost number. Normal cost is representative of what it costs for all of your active workforce to earn 1 year of service in the pension fund. So for everybody to earn 1 more year of accrual in the pension fund, it's just shy of $1 million per year. So that's a guaranteed component of your contribution. Okay, so with that, I'm going to take you to page 10, which will get into the details of that calculation, and you could see all of the components that contributed to that. Okay. So here again in that left-hand column, there's several components that go into the pension cost. Total normal cost is the number that we just talked about. It's 1 year's worth of accrual. Now, all of these numbers have been adjusted to year end. The valuation date is on March 1st. However, we know these numbers don't come into the fund on that date. So we do apply an interest adjustment, as understanding that these numbers are coming into the fund at a later date. So the normal cost is just over $1 million. We add to that the administrative expenses. So the cost to administer the fund on an annual basis, and this is any expenses that you pay for administration of the fund, including any accountant fees, actuarial fees, anything like that is included in here. Legal fees, to the extent that you have, disability cases, anything like that would be considered administrative expenses. This is not investment expenses, it is only administration. If we took those two numbers, and then this expected member contribution number, this $387,000 number, which is member contributions that they pay into the fund, the 9.91% of payroll, and subtract that, that would be the expected village contribution if you were 100% funded. So if you were fully funded for the liability based on service earned to date, those three numbers would determine your contribution: normal cost plus administrative expenses minus member contributions. However, we do have this large number in the middle of this page, the $1.8 million number. That is representative of basically your mortgage on the liability that's already been earned but not yet paid for by the fund. So this is basically an amortization payment of that amount over 21 years. It is using a 3.5% payroll growth assumption, which means that every year it will increase by 3.5%. So at the end of 21 years, that number is going to be over $3.5 million instead of the 1.8 you're seeing today. And if we take that and add it in, by the way, this number, just to note for you, is 71% of the total contribution that the village pays, is just paying down that past service accrual. The expected village contribution is this $2.5 million number here. The other thing I like to point out on this page is the past contribution. So if we look at the expectation from the village from last year, that was the $1.8 million contribution number. The village did contribute that and a little bit more actually. So this is a section I like to look at for the health of the fund. If the village is trying to meet these numbers and if there's effort towards paying this down, typically I start to see the unfunded liability come down as well, and that generally speaks towards the health of the community and the health of the fund. So that's a good thing to see. So it looks like you're all doing the right things so far. If we flip to page 12.
One quick question, sorry to interrupt. I'm just curious, administrative, and this is the tail of the dog. Okay. Administrative expenses went from 0.8 to 1.2% of total annual payroll. I'm just wondering what accounted for that.
I'd have to dig into the details that we have on that. Sometimes we're provided with enough detail to offer you that answer. Sometimes we do not have that. I'm not sure on your fund if we were provided that or not. Usually when I see an increase like this, I could tell you there was a disability case or something along those lines that went into it. I don't know if that was the case. Nikki might
Yeah,
be able to.
I can answer that question, Trustee Rubin. The difference between the two, and judging by your response, I think you just realized what it was, that our pension fund was involved with an administrative review process that did require more legal fees than would have otherwise been required in a normal year.
Got it. Yeah, it's an anomaly. It's not a recurring. Thank you.
Correct.
In the way that we do fund this, effectively administrative expenses are included here as on a pay-as-you-go basis. So they were in the prior year, we just assume it again for the next year.
Yeah.
See that come down now. Given that they're smaller numbers, we don't worry about that on a, amortizing that too much. So, okay.
And I've got a question too before you move on.
Sure.
One of the assumptions you made, I think, was a 3.5% annual increase. If after X number of years that assumption proves to be, say, too high, do you adjust it? Because obviously, if that is too high, then, well, I mean, maybe it's not so bad. I guess we'll be overfunding it. But do you make adjustments in that?
So the way that I'm actually going to move us to page 12 now because that's the next thing I wanted to get into a bit. This goes into the details of that calculate. Wait, I jumped me to 13. There we go. This gets into the details of that calculation of the amortization of the unfunded, and the way the payroll growth function, the payroll growth assumption works is that it effectively takes the unfunded liability, and we reset this annually. So we're always taking whatever the unfunded liability is in that valuation year, and we're amortizing it up to the year 2040. So right now there's 21 years left to amortize this. Next year, this number is going to be 20 and then 19 and so on. So it is always decreasing by 1. And we always start with this unfunded, whatever the unfunded liability is as of the valuation date. So when we determine that calculation, what the 3.5% payroll growth does is basically reduces this amount in the current year at the expense, I guess, of future numbers. Every year, this valuation number is expected to go up by the 3.5%. So what happens next year is when we redo the valuation, we'll have a new unfunded liability. We'll be amortizing over 20 years. We'll still use the 3.5% number, but its really only purpose is to try to link the amortization to the fund payroll. So I guess I shouldn't say it doesn't really matter if you get that assumption right. And in fact, as an actuary, I would love to see that assumption be 0%, which is obviously not reality for how the pay is going to go up. But I would rather see it not linked to payroll, and I'd rather see this amortized like a mortgage, because it means more money is going into the fund today. Basically, you're funding earlier versus the payroll growth assumption it's a form of kicking the can. At 3.5%, you're not being overly aggressive. So I don't know that I'd go as far as using those words, but when you start seeing very aggressive payroll growth assumptions, what you're trying to do is reduce the contribution today at the expense of later valuations where that number will go up quite significantly. So it basically determines the slope of the increase in the amortization amount, but it is reset annually, and there's no overpayment concept possible because you're always starting with your unfunded. And once you have no unfunded, you're not amortizing anything. The payroll growth assumption becomes irrelevant. Okay.
All right, thank you. Yeah,
no problem. And so to that point though, I do want you to understand the power of that assumption. So here I'm showing you the number. This is a beginning of the year number again. So when we roll it into the contribution calculation, we do apply interest. But this is at 3.5%. If I was to drop that down to 2% and re-amortize that, this amortization amount goes up to $1.9 million. So it's about a $230,000 increase to the contribution just by dropping the payroll growth from 3.5% down to 2%. So it's a hard assumption to move because it does bring the current contributions up quite significantly. Now, what it would do is if you drop this down to 2%, it would mean the slope of your amortization payment increase is going to be slower. So you're not going to see a $3.5 million number in the last year of amortization. You're going to see something closer to maybe, $3 million or something along those lines. So it reduces at the cost of paying more today, you pay less later, the lower the payroll growth assumption is. So we always like to see that come down where we can. I don't feel uncomfortable with 3.5% in your fund. It's not, I wouldn't call it conservative or aggressive. Of course, we'd like to see that become more conservative, but I'm not ultimately not too concerned. The good thing about your fund, the position you're in right now with the 21 years left, is that you don't have any negative amortization. What negative amortization is as a result of using a payroll growth assumption, there's always the possibility that the amortization calculation that I determine in year one here is not going to even cover the interest on the growth of the unfunded, in which case your unfunded, even if you pay the full amount that we would calculate, your unfunded grows year over year. That is not happening in your fund. It's one of those things that you hear about in pensions that's sort of a negative thing, and you don't have that going on. So even if you pay the numbers that we are calculating, you will start bringing down your unfunded liability, which is a good thing. So, and that's even with 3.5% payroll growth. If you drop that payroll growth more, you'll pay more unfunded immediately. So you're touching more principal in the short term. So similar to a mortgage, the more principal you pay early, the less interest.
Right, less interest in the long run. Yeah.
Yeah.
Okay,
So it's a similar concept. Okay. So with that, I'm going to turn us to page 14 and then get into some of the details of how the contribution changed year over year. So this page, and I don't think I can fit it all. Let's see if it's kind of small if I do it this way, but hopefully you can see it. If I look at the top number here, this is last year's contribution, this $2.2 million number. At the very bottom is this year's contribution of 2.5 million, and you can see the various categories here that contributed to that increase. And actually, just to make sure that we can all see it here, I'll blow that back up a bit so you can see all the numbers in the middle here. This shows you what items contributed to that increase the most. And so as you can see, the biggest one is the benefits change, the tier 2 changes. So just by the nature of those tier 2 contribution change or tier 2 benefit changes, the contribution went up by $85,000. The other one is that payroll growth assumption. So as I mentioned, every year, the nature of that payroll growth assumption, all else being equal, means that we will see the amortization payment on the unfunded increase every year. And so every year we can expect about a $55,000 increase in the contribution requirement, all else being equal. So those two numbers were the biggest contributors. I did mention investment returns. So 6.5% is our target. 4.5% was the actual on a smoothed asset basis. So we did see an increase in contributions for that. And then the other item was this active decrements. We did see 2 retirements this year. In theory, that will mean less retirements in the future and hopefully some gains to this bucket. But right now it did increase the contribution a bit year over year. So that gives you a feel for some of the things that contributed to that number and that increase. Okay, so let's turn to page 16. And this is the last page that I really want to highlight for you. And this is a projection of benefit payments. So this is basically taking the people that are in the fund today and projecting what their benefits would be if all of our assumptions come true. That includes timing of retirements, that includes salary increases, any assumption that we make in the valuation. We're basically projecting a liability stream of current people in the plan. This does not take into account any future hires, but current folks in the plan. So the number I like to look at in this page is this total payments at the very top, this $3.2 million number. And if I compare that to your market value of assets, just to see how much you're liquidating annually to be able to pay for your benefits, it's about 8.8% of market value. That's a pretty good place to be. You're less than 10%, which means that you probably have enough cash flow to largely be paying that, which means you're not having to worry about liquidating assets to be able to pay benefits and such. That means your assets are probably doing a better job working for you and earning for you. The other thing I like to look at on this page is to see how long it's taking those benefits to change dramatically. And they don't double for about 23 years. So it's a very long stream that these payments do increase. So you have a very long time before you're going to see significant increases in this number. So that's a good place to be. It tells me that your investment advisors probably aren't having to scramble to make sure you can pay benefits So that's good. So with that, is there any additional questions about the results here?
Yes, we generally ask the question, if we didn't pay another dime in, how many years would we be able to pay the people that are drawing before we had to do something, just to have an idea?
So this page probably would give you a pretty good feel for that. So, you know, you have the, what, $35.3 million of assets today?
Mhm.
I mean, you know, that's still going to grow for you, right? You could look at these numbers and just see how many years you could run that out with the assets increasing. I haven't run the calculation to see that, but you could see that how, you know, and I would speculate in something like a 20-year time frame or whatever ish is my ballpark. I'd have to run the exact calculation for you, and obviously a lot of assumptions go into that, but that would be my speculation, just based on what I'm seeing here in terms of the benefit payments that are included in addition to what we expect returns to look like. At some point though, investments do change. So, you know, right now we're saying 6.5%. As your assets started to deplete, you'd probably have to change the way you're invested to ensure that you can continue to pay benefits, and that would probably influence some of the later numbers as well in terms of how long that could really go on. Hopefully that's not in your plans, but.
Oh.
Any other questions?
Heidi, one other thing that we wanted to cover tonight was some options for repayment of the contribution because our contributions are increasing fairly rapidly. What other options could be presented to the committee to consider in terms of paying down that unfunded liability? Understanding that this has become somewhat important from a ratings perspective. We've now had 2 reports from Standard & Poor's that, you know, have really kind of hit hard in that area that, you know, you need a funding policy, you need a formal policy of how you're going to attack this over time.
Sure. So usually, and I flipped you back to this unfunded calculation page because that's usually the place where you have the most power to address how the contribution's moving. If you recall, 71% of the contribution was related to this pay down of the unfunded. So this is really where you have the ability to address that. What we've seen some funds doing, I'd say more funds lately, is moving to an open amortization period. So right now you're in this closed amortization period. What that means is right now you have 21 years remaining, but as I mentioned before, every year that number is going to go down. And eventually, as you start to approach the 2040 date, that number will be 5 years or 3 years. And at that point, this becomes very volatile, and it really isn't a prudent way to fund the plan at that point. What we're seeing some funds do is work their way down to a 15-year period. And then once you get to 15, you're just going to reset this amortization to re-amortize over 15 years every year. So it effectively smooths any gains and losses over 15 years, regardless of what happens year over year. And it allows for that full 15 years to spread that unfunded out over annually instead of, you know, sort of tightening this time frame and making it shorter and shorter. In the next few years, that, you know, what we've seen some funds do, I've seen a couple approaches to get there, is take this 21 years and just wait until it gets to 15. And then once it's at 15, we just lock that into place and say that's what we're doing. Often the funding policy will be written to say that, so that's very clear to outsiders reading the funding policy, that the intention is once we're at 15 years, we will be amortizing continuously over a 15-year period. The other way I've seen this done is similar to that approach, but instead of moving 1 year at a time, they may be jumping 2 years. So we'll move this down 2 years every year until we get to that time period that we're targeting. Most funds are looking at 15 years. 10 years is a little bit too tight to get this funded over because, you know, obviously the shorter this time frame, the larger the amortization amount. So 15 years seems to be a pretty comfortable place for a lot of funds. It's also very easy to go to. It is what IMRF is phasing into as well. So it is something that other funds in Illinois are doing, and IMRF is a pretty successful fund in Illinois. So as funds go in Illinois to look at, it's one that we see a lot of funds go to. So I'd say that's the most popular approach to what we're seeing to pay down the unfunded. In terms of contributions, you do have to keep in mind anything that you change to reduce contributions today will probably increase them later because you're going to pay down this unfunded one way or the other. So another approach, if you have the funds to do so, we've seen some funds just work on reducing their payroll growth assumption, maybe coupled with getting to that 15-year time frame, but reducing that payroll growth by, say, a quarter basis point every year, every other year or something, so that eventually you're amortizing a little bit more today so that you don't see those volatile increases in contributions towards the end of your amortization period. Eventually, you do need to address the years remaining in the amortization. You're 21 years from it at this point, but as you start getting closer to 2040, you will see more volatility to this contribution number just by the nature of being, amortizing any gains and losses over a shorter time frame. So I'd say those are the most popular approaches that we've seen. That open amortization really smooths things out quite a bit. So that's probably the most popular approach that we've seen with most funds.
Is there anything magic about 15, or was it just seemed reasonable?
So most actuaries aren't going to feel comfortable beyond that because it's an open period. So 20 years feels a little bit too aggressive. You're trying, you're pushing too much liability out into the future. And the fact that every year you're resetting to the 15 years, you're effectively going to be pushing out a year every year anyway. And you will eventually fund towards 100%, but mathematically that approach sort of asymptotically approaches 100% funding and doesn't actually get you there. Now, it would eventually get you there because you'd have a year that would pop you over and then fully fund you. But, just by the nature of investments being volatile, you'd go up and down over that. But I'd say 15 years is, because of the openness of the concept, you push it out too much and it becomes aggressive. You just don't want to see gains and losses smoothed over that long of a time period. Usually gains and losses, so I could tell you, when we worked on the corporate side, gains and losses were usually funded over a 10-year period. So the fact that, 15 years is still going to offer a little bit more, it's slightly more aggressive, but I wouldn't call it aggressive. So from an actuarial perspective, you really want to keep that shorter.
And then the sort of percent of funding our liabilities, is that not a good way to measure? I mean, that's what gets into the news of our plan is 58% funding our liability.
Right. Yeah, so you are and that's what you're working your way down towards here. So to the extent that you can pay this unfunded amount down faster, that will increase that funded status more rapidly. It's usually a function of budget at that point, because this number can be quite volatile. If I change that payroll growth, as we talked about, if I move it down to 2%, it goes up quite a bit. And, that's something that you usually need to plan for, budget for, and understand the impact of how that's going to look. Now, long-term, it's a better place to be because you won't see the increases on the back end, but it's usually pretty hard to stomach short-term and takes a bit of planning from a budget perspective.
Nikki, are the concerns that were expressed by the rating agencies, would those in fact be addressed if we changed the plan to indicate that when we got down to 15 years remaining, we then had a rolling 15 years? I mean, clearly you're still going to have to pay more money going in, to the fund for some years to come. The numbers will be going up. The math is what it is. But would that address the issue well enough for the rating agencies?
Yes, in short. What the rating agency wants to see is something solid from the leadership of the organization on paper that's committing to address the unfunded liability in a reasonable manner. What they're concerned about is essentially default, that if we're using something like Heidi mentioned, if we switch our methodology from entry age normal to a projected unit of credit, the closer we get to that closed amortization period, that contribution will very quickly outgrow what we could withstand, especially as a non-home rule community, where you can only levy so much, now you're searching within your operating budget to make up that pension contribution that's required. So what the rating agency wants to see is some type of reasonable approach to funding that's sustainable in the long term for the community.
And usually the payroll growth assumption is the most powerful way to address that in terms of that long-term perspective, because if the rating agencies are concerned about those spikes on the back end, which they rightfully should be, that's where, you know, if I tell you that this number and at the end of this goes up to $3.5 million, if they understand that calculation and realize that, they may be looking to the community to make sure that, can you sustain this number going up to $3.5 million in a 20-year time frame? I mean, that's a big increase over that time frame. And just to make sure that that's being addressed and thought about. If you reduce down from 3.5% to 2%, that $3.5 million number is now 3 million, and it's maybe a little bit more, you know, because it's not such a spike at the end, it's more comforting to understand that you're paying more today, so that you have a more level contribution in the future. And you're paying, you know, by paying more today, it does increase the funded status, which always is going to give comfort to the rating agencies as well.
Any other questions, anyone?
Should we be working on a model for what it would look like to make our agencies happy, to draw up what that looked like so we can see what that would do to our annual payments over the next 20 years and make a decision on whether to adopt that?
We'd be happy to work with you to show you some illustrations of the various, you know, methods that could be employed, just taking this year's results and showing you what those projections could look like. And, you know, I don't know how open you are with the agencies to having the discussions directly with numbers and such, but internally at least to understand how that will change and what you're comfortable with as a finance committee adopting for a policy based on looking at actual numbers and future projections.
Yeah, but it seems to me we need to begin looking at that, because we're going to have to figure out how we keep the agencies comfortable while we borrow money to do various critical infrastructure projects. Does anybody disagree with that?
No, I think it's a good idea.
Thank you.
Makes sense to me.
Right.
Agreed.
So we as staff will work with Heidi and her team, and we'll bring back some recommendations for the committee to consider.
Sounds good. Happy to.
Okay, anything else? All right, thank you, Heidi.
Okay, let me.
Thank you.
Thank you,
Thank you, Heidi.
Help out.
And now we can move on to the discussion of the refunding our Series 2012A General Obligation Bonds.
Okay.
There we go.
All right. Thank you. Okay. Just getting there. Okay. Can everyone see my screen okay?
Yep.
All right, perfect. Okay. So moving on to the refunding series of 2012A. As part of our regular process with the village's financial advisors, which is Spear Financial, every year we take a look at the village's existing bond portfolio to identify any potential for savings. And so we could essentially refinance some of our bond issues. Now it's important to remember that depending on how the bond issue is structured, not all bond issues can be refinanced or refunded on demand. Some of them, most of them have call options that are valid within a certain period of time during the life of the bonds, which is why we take a look at it every year. And there are some restrictions on how far in advance that you can actually refund the bonds. So this year, as part of our review, one of the issues that we identified was the 2012 series. Understanding that the markets have been a little unpredictable lately. These numbers could change, but our initial analysis is showing refundings in the ballpark of approximately $300,000 over the remaining life of the bonds. So that would be money that we could save in terms of repaying these bonds back. The obvious benefit of doing this would be to lessen the amount that the village levies in property taxes each year if we're able to lower that annual payment. So in total, there's about $7 million in principal remaining on this bond issue. Originally, it was just over $8 million, and it was used to fund part of our capital program. And the average coupon on the original issue was about 4%. So what we're looking at here, our average coupon's around 2%. Which is, significant savings. And as we started looking at this, there is something called bank qualification when a government issues bonds. And essentially, that gives a little bit more comfort if you're borrowing less than $10 million in the borrowing process, you're able to secure lower interest rates. With the bond issue that we did earlier this year, the amount that we would need to refund Series 2012A would put us slightly over that $10 million threshold. We want to try and stay underneath that threshold to secure the lowest interest rate possible. If we're not able to do that, then a refunding might not make sense. So what we have for the committee to consider this evening are 3 options that would allow us to realize these additional savings. So option 1 is similar to refinancing a mortgage, right? To just make sure that you're lowering your interest rate. Option 1 would be to contribute approximately $140,000 towards the issue to bring the amount down that we need to borrow in order to refund the savings or refund the outstanding bonds. And this required funding could come from reserve funding, either from the debt service fund or the general fund. Option 2 would be to do what's called deem designate the issue as bank qualified. This requires the restructuring of the bond issue, and it's allowable. It's essentially a way to isolate this issue to consider it on its own under the $10 million threshold. And you're allowed to do this if the refunding issue itself is going to be less than 10 million, if the original issue is bank qualified, and if we maintain the essential footprint of the original issue. So in terms of the timing of the maturities, the repayment, you can't extend beyond that original footprint. So that is something that we would qualify for here. Option 3 would be not to refund the 2021 maturity of this bond, which would cause us to have a negative debt service savings in the year 2021. So we would actually pay out a little bit more than what we would today. When looking at these 3 options, the total savings varies based on the option that's chosen. So if we were to pay $140,000 upfront, the savings with option 1, with just using current market estimates, conservative estimates, we could save something in the ballpark of $450,000 between now and the end of the debt service, which would be around December of 2027. If we were to elect option 2 and deem designate this issue as bank qualified, we would save somewhere in the ballpark of $320,000. And option 3, if we were not to refund that final series, we would save about $300,000. assuming the assumptions that we have today.
Is-
Now, oh, go ahead.
I was just going to say, so in doing this, before we talk about the options,
Sure.
is there any way to leave the tax levy alone and refinance this, or does the 300, whatever the difference is, all go to taxpayers and none of it actually stay with the village?
It would all go to taxpayers.
Okay.
That's a good question.
Yeah, so
Because
if we think about option one, it's costing the village 140 to then give back money to all of the residents. Option two doesn't really cost us anything, but we give back a little bit less. And in this environment, but you know, the cost to us is significant. And then option three has a cost too. It's just next year, not this year.
correct.
Okay.
It's a great summary. So for that reason, from a staff level, especially given, you know, obviously I need to go back and look at that, our cash projections to make sure all of those numbers are accurate, but understanding that we could be under constraints from a revenue perspective, from a cash flow perspective, option one would not be something that we would be recommending from a staff level. Option three is tricky because it would increase our costs, to your point, Trustee Bree.
I mean, to my mind, option two is, I mean, we certainly should do this because we can save money for everyone.
Mm-hmm.
But in the environment we're in, where earlier in the meeting, we were talking about all of the revenue shortfalls we're going to have, I think we need to try to protect what the village has also. And so it would seem option two makes the most sense.
Well, when you've got net present value benefit, so that appears to take into account whatever upfront dollars we're spending,
Correct.
as well as the future savings, even though they're coming, so to speak, from different pots?
Correct.
Okay.
Sorry,
Because the first two options are the same. We're just not spending the money up front. And the net present value is still the same. The option two and option one are almost identical.
Hold on. Let me look here.
Would it be correct to
Savings
say,
for 450 versus 300.
Oh, I understand. Yes, you're correct.
Yeah, and in the analysis, if you go down a few lines, Jonathan, they're essentially a wash from a net present value perspective.
Right, 292, 857, 88 versus 292, 402. I mean, hundreds of dollars different.
Okay.
Correct.
and as I look at this, am I correct that what you say about option two, or the way to describe it is, it doesn't cost us, the village, anything at a time when we need to conserve our funds, not knowing what's coming next year, but it, under that circumstance, it maximizes to our residents the maximum they can get without us having to take on the injury of the 140.
Exactly.
Well, we're still taking out about 40, it seems, but we're saving about 100.
Correct.
So we're still coming out of pocket a bit, but far less, and the net present value runs the same. So
Is there
option two looks good.
Is there a way to put, if we were to use the 140, put that back into the bond? So the amount we borrow, I mean, if there was a difference, if they're all the same, it doesn't matter, but to sort of put the expense of it to the village back into the bond, if it were to make sense?
To roll it in, like similar to like how you would roll in closing costs.
Right,
Yes.
we're gonna borrow 8 million to then borrow 8,140,000.
Correct.
Yeah.
So in option one, the pay down of 140 would be to reduce the amount of the loan to maintain the bank qualification status.
Right.
So, and you're correct, actually, to highlight the 40,000, that would be closing costs that we would be on the hook for no matter what. So we are actually rolling the closing costs in. We would have to do that in all three of these options because there is a cost. Unfortunately, we still have to do a ratings call. We still have to produce an official statement. We still have to pay a bond attorney and the financial advisor to actually do the transaction. So that would be true in all three cases.
But that gets rolled in?
Correct.
So when we say it's a transfer from prior issued debt service fund, I thought that was taking money from a pot that we currently had that we're perhaps going to use for capital improvements or otherwise. You're
Correct.
saying no.
Sorry.
Okay, well then I'm not understanding. Either we're rolling it in or we're
Okay.
not rolling it in.
Yes, you're correct. So the 140,000 would be above and beyond the closing costs. So that dollar amount would be just to reduce the amount of the loan. So it's like a down payment on a mortgage, and that you are correct, we would have to pull that out of a fund. Right now, we do have money in the debt service fund. That's used for cash flow purposes, so that if, the county were to, I don't know, extend their deadline for the second installment by 2 months and we don't get enough money to make debt payments in time, we would use that debt service reserve to help us make those debt payments. So that was why we kind of threw out there, either you would use the debt service fund or the general fund or the combination of the both. So that 140 would be essentially the equivalent of like a down payment on a mortgage. And then the closing costs would be rolled in all three options.
Well, the second option though, instead of 140, it's 38,530. So why is there the pay down in the second option?
That's the closing costs.
And that's going to be in there irrespective of which of the three we do.
Because
Correct.
the first 140 didn't have 140 plus. So you're saying it was about $100,000 in pay down. You just netted those two together.
Correct.
Thank you. Well, I still think the item 2
sounds
more. Seems the best to me.
Okay.
And it seems like a nice thing to do.
Yeah, absolutely.
So it's all around good.
And good for our advisors for pointing it out.
Yes, this is great. Okay, so I think we have our direction on this.
There are some steps that we'll take and that the board will have to take as well relative to a bond ordinance, which will come before the full board in September. Nikki and I are participating in a ratings call next week with Standard & Poor's. And the timeline is that we would look to a bond close by the beginning part of October. So trying to get in under the wire as the market continues to be favorable.
Thank you, Phil. Okay, and that would be kind of my next slide. Are there any other questions on this process? Okay, well, thank you.
All right, moving on to the discussion of financial policies.
Okay, and for this, I'm going to call on Denise Joseph, our Assistant Finance Director.
Okay, thank you, Nikki. So as part of the budget development process, annually staff seeks guidance from the Finance Committee in the update and review of the village's financial policies. These policies are included in the annual budget document and address many of the driving forces that guide the budget. So the recommended changes have been identified for you, and it's available this evening for your consideration. I do want to mention that in your packet there is a clean version as well as a red line, just kind of tracking the changes. The first recommended change is in the fund balance policy, and actually we're not currently recommending any changes, understanding that we may have some revenue shortfalls. However, the committee may consider whether one-time increases in building permit revenues should be designated to fund future capital projects in the current year. Moving on to property tax abatement, staff is recommending that the debt service payment for the Series 2020 alternate revenue source water bonds be abated and paid from water fund revenues, as this bond issue was entirely dedicated to fund water infrastructure projects. And the total of this aggregated payment will be $181,900 through the end of calendar year 2021. limited tax authority. The availability of limited tax debt is a resource that the village can use in the event of any economic downturn or other identified and unforeseen need. Limited taxing authority may also be considered by the village board to assist in funding a large priority capital project. Staff currently is recommending the review of this during the calendar year 2021 budget process to possibly utilize this in funding the 10-year CIP project plan. Management fees.
Could I ask a question? If we did
Absolutely.
I'm sorry, what?
Absolutely. Go ahead.
If we made the change, and I realize right now we're just saying consider it, but if we made the change, would there be anything left in that property tax availability in case of an emergency, like a drastic reduction next year in revenues, where we might need to borrow to cover some emergency project?
Denise, I'm not sure if you're ready to answer this, but it would depend on the size of the bond issue. So right now, I'm looking to see what our current authority is at. Give me just a moment, please, because I just had this open.
Right, because we've used part of that authority.
Ah, there it is.
1.8 million for the Tudor Court.
It did.
That number, one thing I would note is the question of whether or not the entirety of it would be used in the fulfillment of the CIP for calendar 21 or a portion of it. And that would certainly be a policy question that the board can grapple with as you get a sense of what the CIP would look like. But Nikki, I can't remember the number, and you seem like you may have had it.
I found it. So it's perfect timing. The allowable extension that we have right now. Oh wait, where did that go? Oh, workbooks. Just want to make sure I have the most current. Okay, the allowable extension allows the village to have a payment of just shy of $600,000 a year. Understanding that we've tied up some of that in the 1.8 that I'm sorry, I'm like pointing here. We have tied some of that up in the Tudor Court bond issue. What we have available is about $400,000 a year, which would allow us to do an issuance of approximately $3 million using kind of conservative interest rates. So it's certainly not a lot of money, depending on the duration of the bond that we move forward with, but it is significant in terms of capital funding. I mean, $3 million gets us a long way with certain infrastructure. So that is certainly something you do not have to use at all. We could use half of it, you could use a portion of it, or you could use all of it. And then as the debt payments fall off with each of the issues, then that funding becomes available again.
So while I would think it's prudent for us in looking at next year to be able to consider all things, including that, I think we're going to have to be very careful when we get to next year's budget, not to leave ourselves in a position that if the funds fall, our cash flow falls as much as sometimes the state of Illinois thinks, that a emergency project for say $1.5 million would leave us with nowhere to get the money.
Correct.
So with that caveat that we have to look very carefully when we do it, I don't see any reason why we shouldn't consider what to do when we're trying to figure out what the staff recommends to us as a budget. But I think our message ought to be, we really worry about, given how volatile next year looks, whether or not we might not need that in case of emergency.
Mm-hmm.
Yeah, and given where we're projecting
revenue,
lowest fund balances in any given month to be, and what our stated minimums are, which seem reasonable and not not, you know, I don't really want to play with them necessarily. I'm in agreement with President Levin.
Okay. Okay. Understood. Thank you. Moving on to management fees. As you know, the village charges a management fee for the village cost of assistance to the Glencoe Golf Club as well as the water fund. Water fund management fee is collected on a monthly basis, and the present policy for the Glencoe Golf Club is to accrue the fee but not collect the fee. Staff's recommendation for the water fund is a 2.5% increase. This is consistent with the CPIU index that is used for the property tax levy ordinance as well. At this time, staff recommends that the Finance Committee discuss the amount and collection of the current year for the golf club management fee in conjunction with financing of future capital improvements to the clubhouse. Next slide. Pension funding. Oh, go ahead.
Let me just offer a thought going back to the clubhouse one. At the time that we adopted accruing the fee but not collecting it, the thought was that that would give a period of time for the golf course to accumulate some cash to use to pay the cost of doing things like floating bonds or taking the steps necessary in order to actually construct the new clubhouse. I think that staff should look at all that and make a recommendation to us, because I think they have sufficient cash on hand that if we don't ask them to repay lots of what they owe to us right now, they should at least be able to then pay the appropriate cost of services provided similar to what the water fund does. And so I think we would like a recommendation from the staff on that as the staff looks at the current budget, because things are tight enough that it may be the staff will feel comfortable that the golf club has what it needs to be able to move forward.
How much was the management fee?
I'm sorry, I didn't hear that.
Just how much was what number have we been using for a management fee?
I believe it was in the ballpark of 45,000, but let me pull that number for you.
It's roughly in that
Mm-hmm.
area. We will look at that as a component of the overall budget development. The recommendation from staff to President Levin's point is a good one. I think what we would want to make sure is how that comports with operations at the club, as well as where our current situation is here at with the general fund. No doubt there are services provided from village operations to the golf club, and at the same time, golf club need for investment remains in its facilities. So we will come back to you with some recommendations as we move forward through the budget process on that. Generally, tonight wanted to see if there was any initial thoughts, which you've provided, so that's helpful. Thank you.
And actually, I'm sorry, just a point of correction, that 45,000 number was the water fund. The placeholder that we have in the budget in the current year was 20,000 in the golf fund.
And that number was reduced.
It was. You are correct, in the current year.
Typical, similar cost structure between the water fund and the golf club.
I mean, one thing to think about would also be, how do we come up with the 20,000? What's a reasonable number to consider? The golf is one of the few revenue sources we've got, so we've never really used it. We've always let them operate on their own. Now, understanding they have significant capital expenditures in front of them, but at the same time, we do too. So maybe thinking about whether they can afford it and what's a reasonable number to use.
Jonathan, I think one of the things that's probably prudent in this is to take another look at how those management fees are generated from the standpoint of the blend of the hourly rates of the staff support and how that has been structured over the years. It's been a little while since we've taken a look at that, and I think it may be worthwhile in this effort just to kind of reassure ourselves that it's the right blend, or whether there need to be some modifications, and then we can share that as part of the recommendation that we come back to you with.
I think a fresh look at the whole thing.
Yeah.
Yeah.
Okay.
That makes sense to me, because I'm looking at and I guess I just haven't been around long enough, because I look at it as my left pocket, my right pocket, because it's all us. It's all us on liabilities, and it's all us on revenues, and it's all us on everything. So I'm looking at the money that's sitting there, but I understand why it's sitting there and how it came to be there. And so now the question is, should there be any sort, as Jonathan points out, should we start looking at some of that in terms of the revenues it's generating and pulling, something towards our general fund from that, certainly in compensation for the services provided, if not otherwise. I think that's a reasonable thing to be looking at, especially right now.
And we have to be looking at what's going to happen. Where they're going to be able to run it and earn enough to pay their way, because this year there were all sorts of interruptions and issues, and so a total fresh look at what they can afford, where they are, and where we're going. I think have staff look at all that and then report to us will help us understand what we should.
And we've been fortunate in that we have such phenomenal management of that golf club, and they do such great work that they're doing really well.
As we always say, the nice lady that runs the golf course has a really good pipeline up to the man upstairs.
One thing also, maybe speaking of Stella, just sort of her plan. We know the clubhouse is the big one, but they always invest, if I remember, it's somewhere in the $1 million range every year back into the club. What amount, and that's been primarily to upgrade the club over the last decade. Do we still need to invest the same amount? I mean, sure, we would like to, but do we have to? And so,
yeah, and I think that's a fair question. We'll circle back as we develop the budget, and obviously the golf club budget is a component of the overall budget discussion. I think there's certainly, as we look at making sure that the club remains competitive with other golf courses around here. 2020 is a bit of an anomaly year because we've got one major competitor that's completely closed for the season. And that's helping, in addition to the fact that the COVID crisis has altered, I think, what people are able to do from a standpoint of recreation, which is also, I think, driving the numbers at the club. That being said, last year was probably one of the worst years we've had in a long time. So it's a very fluid movement. We'll want to be very conscious of whatever recommendation comes back to you all before we overstep, and with the full realization that there is some significant investment that's going to be necessary sooner than later from a clubhouse standpoint, not just from the day-to-day operation. So we want to be conscious of that, and we'll be careful with that. So we'll come back to you with some recommendations once we have a chance to reevaluate that up against everything else.
I mean, the one thing about the clubhouse is it's going to have a bond attached to it, so hopefully, unless we can fund it in other ways where there's.
I'd love to think we can raise the full cost of the clubhouse. It would be a wonderful coup if that were possible.
Okay, thank you. Nikki, next slide. Thank you. I know we spent quite a bit of time this evening talking about pension funding, so I just want to highlight a couple things. Staff is recommending using the village's actuaries required funding of $2.5 million. As we stated earlier, the fire pension contribution will continue on a pass-as-you-go basis. And we will definitely be bringing back some changes on enhancements to the pension funding policy as we discussed earlier this evening. The next item is the IRMA liability policy and surplus. The village, as you know, purchased its general liability and workers' compensation insurance coverage through the Intergovernmental Risk Management Agency. Currently, staff does not recommend any changes to the deductible policy. However, as part of the upcoming budget, staff is recommending that the village discuss using IRMA access surplus to offset some safety-related capital improvements, deductibles, or premium costs during the budget process. Just to make mention, since fiscal year 2011, the excess surplus amount on account with IRMA has grown to approximately $1.1 million. Fees and charges for service. As we do every year during the budget process, we will do a comprehensive fee and fine survey, as well as evaluate some of our current costs and certain functions. Staff is recommending some updates to the fee resolution, and those will be brought forth and included in the proposed calendar year 2021 budget. As well, staff is recommending the permit revenue projections be analyzed to determine if a transfer may be made to the general fund into the capital projects fund to fund future infrastructure improvements. On to some new policies. The first one is the fixed asset capitalization policy. So the purpose of this policy is to establish a uniform capitalization policy that complies with financial reporting requirements. These will be in accordance with the general accepted accounting principles, as well as requirements from the governmental accounting standard boards. So historically, the village has capitalized assets purchased or acquired with an original cost of $1,000 to $100,000 or more, depending on the asset class. These are reported at historical cost or estimated historical cost. Staff is recommending to more clearly define these classes of assets to be capitalized, and by raising the capitalization threshold, as is shown on this slide, to a larger amount. This will reduce quite a bit of the administrative burden that's associated with some of the smaller dollar transactions. Any questions on this one? I know this is a new policy. About fourth, okay. Moving on to the Intergovernmental Personnel Benefits Cooperative Reserve Fund. The village participates in IPBC, which is a public sector health insurance pool. IPBC currently has 3 separate funds. The administration fund, from which plan administration fees are paid, the benefit fund, from which the PPO claims expenses are paid out of, and the terminal reserve unrestricted reserve fund. The funds balances accumulate in the administration and benefit funds when payments made by the village exceed the cost of the claims. And the fund balance accumulates in the terminal reserve fund when the village's subpool receives HMO surplus dividends. Because both of these funds are used to pay expenses during the plan year, IPBC requires member municipalities to meet minimum fund requirements as illustrated on this slide. Staff is recommending that we adopt a reserve policy, as well as using excess balance as potential source of funding to offset some of the insurance, wellness, and benefit costs during the calendar year 2021 budget process. Next slide.
One sec, sorry.
Good.
To be clear, this is a question of adopting a more formalized policy that comports with what we're already doing, because I see that we are, in fact, over-reserved from the red line that I read. So this really isn't effectively a change for us in any material fashion in terms of, or an extra expense. This is just formalizing what we've been doing.
Correct.
Okay,
Yes,
thank you.
and the only change, Gary, that I do want to highlight is that this is, it was only recently that the village got to a point where we do have excess reserves, which
Okay.
is normal in a pool environment. It does take a
Mhm.
while for the claims experience and the premiums to work themselves out. So what we really wanted to identify is that, you know, there is a potential now. This is another source of funding if we need it,
Okay.
and that part is a little new.
Okay, thank you.
Thank you. And then moving on to the next slide. This evening, we're looking for the committee's feedback on the following policies: the transfer of the building permit revenue to fund future capital projects, changes to the village's abatement policy to allow for repayment of the water fund debt through water reserves. And then the third one, and we touched on this a little bit, is the management fee, collecting the current year fees from the water fund, and then further discussions on the golf club.
And Denise, if you
All right. No, go ahead, Nikki.
Denise, if you don't mind, just one thing that I wanted to point out on the water fund abatements is that in the structure for the water rate increases that we've been making in accordance with the study, the repayment of the water fund bonds was anticipated through water revenue. So that is built into the rate increases that we've been making. That assumes that we will generate enough water revenue to make those debt payments, which is why we're recommending that.
The other point that I'd make on the first bullet point is that you may not have a sense yet of what you want to do as we talk about potentially new building permit revenue that may come in 2021. Obviously, this relates to the potential development of the Hoover Estate. Something that has not yet been approved by the village board is going to be considered this Thursday and then again in September. We had talked about this last year with some expectation that perhaps that process would move forward during the calendar year, and then COVID reared its ugly head and changed scheduling around. We are, I think, at this point simply wanting a general sense from the committee as to whether or not we should work to designate any, and we would have we would look to create a number based off of estimates that we have in place already, and then update them as to whether there would be a more formal transfer to the capital projects fund, or if those dollars should be considered to be maintained in the general fund, depending upon where we start to see our draft budget take root. And if you have a specific and strong sense of one or the other, we wanted to just gauge that this evening.
Didn't we talk about using the general fund for capital expenditures also tonight? I'm not forgetting anything, am I? Or
we do, and the general fund certainly accommodates a significant amount of capital investment.
But so if, I mean, you're sort of duplicating it. If
right.
Building permits.
What we had talked about last year was legitimately dedicating these resources because they were one time and new.
But now, if we've got, you know, the revenue situation is different than it was a year ago.
Yep.
And still giving ourselves the ability by allowing for capital expenditures to come out of the general fund to use the building permit revenue. Now, if there's a reason as far as getting this thing, you know, popular with the community, and that we dedicate some of the money to capital expenditures, I suppose we could do that. But I think we're taking care of it by allowing for the general fund to pay for capital expenditures.
I think Jonathan and I are thinking along the same lines. I don't see any reason why staff should be, given everything else they have to do, spending a lot of time trying to figure out something special here. Let's just, given what we've been hit with, the tsunami, leave things as it is, leave the money in the general fund. And it should only be that things turn out so well, we revisit this topic.
And I think, if I may, to add to Phil's point, obviously we're in a different scenario than we were last year. the long-term goal, I think, was to identify certain sources of revenue to make the capital program more self-sustaining. Understanding you had a dedicated source of revenue, that it wouldn't necessarily be coming from general fund reserves, that we would have some specific reservation of ongoing revenue that would fund the capital program in the long run. So this was kind of a long-term goal. Obviously, in the short term, that may not make sense. So your feedback is very helpful in helping us to formulate a recommendation for you.
Yeah, right now, I feel like we need to leave as much flex. In addition to the points about not spending staff time unnecessarily, we need to be as flexible as possible. And I'd rather not have to find that we're moving revenue from some special fund back into the general fund.
Right.
That's a good
I
point.
think we'll just maintain our flexibility.
Yeah.
Helpful, thank you.
As to the abatement for the water fund bonds, I mean, I anticipated that, absent calamity, we would absolutely, I mean, that was why we raised the rates and built it into it. And we took that into account, expecting to spend this money for this exact purpose and fund these bonds. So I think we should definitely do it now. And again, absent calamity, I would anticipate coming to the same conclusion in future years, although I realize we do legally and operationally do that year by year.
Correct.
Yep, I agree.
Great. All right.
Thank you.
The only question I had on the water fund fee, management fee, is the 2.5. I can't remember where we came up with the 2.5. Is that from all the studies we did, or is?
Not with the management fee. No, the rate structure is separate, and the rate structure, I think, is projected to, the recommendation will come back to you at an 8% increase for next year. We have generally tied increases to various aspects of the budget, such as a management fee, to a variety of things, CPI or cost of living adjustments. CPI is projected to be 2.3 next year, and I think that's the increase that Nikki has proposed.
I think it was actually 2.5, so it's slightly higher. But we could easily put that at 2.3 to keep it consistent with prior years.
Or it could be another number as well.
Right.
I was just curious
if we're going, yeah. And
The
if we're going to
starting point
analyze
is-
it.
Yeah, the question is more the starting point, I think. It's sort of like, what is it covering?
Right.
Versus how much is it going up?
I think as we look at that fee structure and the way that it is generated, as we come back to you, we'll have a clearer sense of a recommendation on any sort of change. And it may not be tied to anything other than we've reevaluated it and determined that the balance was out of balance, and we've rebalanced it in this way. And that's where the increase would come.
Mm-hmm.
Sounds good.
Excellent.
Great. Thank you.
Are there any other questions on this?
Okay, should we move on?
Yeah.
What are we moving on to? Forecast assumptions.
Yes. Okay. Home stretch.
We're using
Here.
Nikki's crystal ball tonight. Others have
Scary.
their own crystal balls that they may want to employ in this conversation.
Yes. Thank you, Phil. That's a great segue.
All right.
These are strange times, and that's a great way to describe it. Is there's a crystal ball, and who knows whose is going to be the most accurate. This is going to be a tricky budget process, as I'm sure you all realize. The numbers are changing day by day, so this is something we're going to have to be very flexible with. So. As you may recall from last year, this is a typical part of the budget process. This is where we start. We're seeking guidance from the committee, your opinions on what we've come up with and what you think we should use going forward as we start to develop the budget process. Just kind of a recap of where we're at today. Each of the departments are preparing their budget requests. The manager has given kind of general guidance as we go through that, and ultimately we'll have to adjust according to where our revenue projections fall. So looking at this from a holistic level, this is a 5-year forecast. It starts with the village's first calendar year ever, and it's going to go through calendar year 2025. And the assumptions are based on what we are estimating today in terms of current economic conditions. Actually, that rising inflation should go away. But our anticipated impacts of COVID-19, the existing financial policies, the changes that we discussed this evening, what we know about existing state and federal regulations and what we think might change, and any other budgetary impacts that we're aware of today. So just kind of looking at this at a high level, similar to last year, our contractual and commodity costs are rising. Tariffs certainly have not helped us in some odd ways. Just thinking about the security camera project, some of the supplies that we needed for that project were much higher than what we anticipated because of tariffs. So these are the types of things that we need to consider as we go forward with new purchases of equipment and replacements. Obviously, we're including increasing pension costs. There is a placeholder in the forecast assumption of 5% per year in the out years. That may change dependent on the recommendations that come forward with the actuary and the direction that the committee and the board choose to go moving forward. That may increase, decrease. Well, it's probably not going to decrease. Capital is still being evaluated. That's something we're going to bring forward to the board for your consideration shortly here. On the revenue side, I think we already mentioned this evening. Department of Revenue has already informed us that the max increase on the property tax levy is going to be 2.3%, give or take, new growth in the village. So that's something that we'll bring forward as a recommendation in the budget. As Phil mentioned earlier, the water fees are recommended to increase in accordance with the rate study, which is an 8% rise in 21. And continued increases in the sewer fees. I'm sure you remember this from last year's budget process, but we do still have that need to address the inflow and infiltration of our sewer system. That's an ongoing mandate that we are going to have to comply with, and we do need a funding source for that. We're also proposing a recommendation on the garbage services fee to increase that by CPI as well. That would be consistent with what our garbage company has indicated for their fee structure as well next year. And then obviously building permit revenue and sales tax revenue are pending additional information. What we see in the month of August is going to be very critical in terms of indicating where our sales tax revenue is going to go. Right now, it seems like there may be a little bit of a light at the end of the tunnel, even though this month's numbers were not great by far, but the following month, we're starting to see that come back up. What we really are going to need to watch is the next month to see where that's trending and how far we think this is going to rebound given the current restrictions that are in place. So included in your packet are several exhibits. Table 1 lists some of the iterative assumptions, just high-level conceptual things that we're grappling with as we compile the budget. I won't go through each one of these, but some of the obvious ones I think we've talked about tonight. Obviously, the COVID-19 pandemic and where that falls is going to be a critical driver of this budget process. Understanding that that's impacting our economically sensitive revenues. Depending on what happens with statistics, whether we continue down the path of reopening or we encounter a second shutdown, will drastically change these projections and these numbers as we go forward. We talked quite a bit about market volatility tonight with the Village's investment portfolio. That's something that we have to watch, particularly in the pension fund. Even though those gains and losses are amortized over a period of time, they do still have the ability to impact our bottom line quite a bit, especially if there's a negative return. Public safety pension consolidation, obviously we're hoping to realize some savings in the future, but as Heidi indicated earlier tonight, there are likely going to be costs up front to that. So that's not going to be realized immediately. The thought process on the state of Illinois progressive tax referendum, or fair tax, however you want to refer to it, the states indicated that a lot is riding on this, and if that's not successful, we do have the danger of losing a portion or all of our share of income tax. That's a significant revenue for us. If it does pass, there's no guarantee that that will stay the same. So that's something that we'll really have to watch come November. And that kind of goes hand in hand with that second line there. Obviously, property tax legislation continues to be a concern. As a non-home rule community, we are subject to that PTEL. So any additional changes to that, we're very sensitive to. Also, there's quite a bit unknown in the next state fiscal year budget process. Unknown at this time, and that will largely depend on the referendum results as well. There are some positive things in here. I should mention that the Village's local fuel tax did go into effect in July. We don't have those numbers yet. Well, we will report those as soon as we get them. The fact that we got Rebuild Illinois grant funds is huge. That will be a great source of capital funding for us in terms of road programs, and obviously something to think about in terms of when we're talking about capital, the success of bond referendum efforts as we move forward and we start to talk about financing plans. Table 2 included in your packet includes, I'm sure you're all familiar with this format here, but these are some of the large assumptions that we've included looking forward in terms of the property tax levy. We've considered here, let me get in here, change in CPI of what's allowable for the following year. And then the out years are based off of the Congressional Budget Office projections, their forecast on CPI, what it may be going forward. We are considering a continued decrease in sales tax. Perhaps that's too much, not enough, but that's something that this is going to have to be a number that we continue to monitor and update throughout the budget process. Similar with income tax, this is based off of the per capita estimates that were provided by the Illinois Municipal League. Utility tax is based off of trend. Consumption, we are seeing that decline. Some of that's weather dependent. So as we get milder temperatures, whether it's cold or hot, those tend to decline. Building permits is a little bit of an anomaly. We've seen that obviously our revenues are less than what they were last year, but we have seen steady activity. So we aren't proposing a large decrease in that, especially with the potential outcome of Thursday and next month, depending on what happens with the redevelopment on Green Bay Road. There could be the possibility for new construction there, and obviously that would impact that revenue greatly. Moving down the line, we did highlight the amount of the Rebuild Illinois funds, and as I'm looking at this number looks too high. I think this is the total that we're anticipating over 3 years. So we'll just say that that's over the 3-year period. Use tax, we're projecting to stay relatively stable, maybe dip a little bit next year, depending on what happens with the state revenue. We're hoping that parking fees will recover. We're anticipating going live on the automated parking system no later than January 1, I guess potentially a little bit sooner than that. And that will largely be dependent on what happens in terms of trends in the workplace, whether people begin to return to work. If you've been downtown Glencoe and you've seen the commuter lots, they're still eerily empty. So that will depend on, you know, what happens in terms of people's comfort level. PPRT, we talked a little bit about this earlier today. We are anticipating a 17% decrease. That is a continued source of revenue that the state is targeting as additional funds for them. So that's something that we're continuing to assume that that's going to go down, and perhaps negative 0.2% is not enough. But that is something that we don't anticipate being restored anytime soon. Moving on to locally controlled revenue, we have plugged in the water rate study rates for both volumetric and fixed. The big variable here, obviously, aside from being weather dependent, is the new meters and what will register there. Whether that makes end users more conscientious in terms of what they're using water for, or are we going to capture more water usage with just that much newer technology? So that's something we're really going to have to monitor from year to year and update. The garbage fee we talked about a little bit, the sewer charge. Vehicle stickers, we're just assuming that that's stable rates, relatively flat revenue. Ambulance transport, we have kind of a CPI methodology there, assuming that those rates may change. E911 surcharge revenue, that's a significant revenue for the general fund. But we do recognize that there's a possibility that that may go down just due to consolidation efforts. That I don't want to say that that revenue is going to go away, because I really hope it does not. But I don't see that increasing. And then alarm permits can vary based off service calls. So again, you see kind of a big jump here. Some of that is the transition from stub year to calendar year. So don't let that number fool you. But it would be, you know, normalized, fairly consistent with a CPI type increase. Moving on to expenditure assumptions. In terms of salary, we do have an attrition number there. I think we indicated in the memo, we have a relatively flat number on salaries. This looks like a large jump, but you know, remember that this is only 10 months worth of salaries, so we have increased that to accommodate a full 12-month year. However, we do have a collective bargaining agreement that would require a 2.75% increase for one of our bargain units. And then our second bargaining unit is up for renegotiation as of the end of February. So there's a big question mark there. We're also assuming in some of the out years, just as the village becomes leaner and meaner and takes a look at different ways of delivering service, there's a possibility that we may be able to reduce headcount through attrition and just evaluating how we're delivering service. So that's all incorporated in these salary numbers here. We are anticipating a slight increase in benefit costs based off of how our plan is running this year. That's something that we're considering this year, every year, and in future years. Are there plan design changes that need to be made that can help us save money in the long run? So that will be largely dependent on experience and those changes that we bring forward as recommendations. Again, pension contributions, we've kind of plugged in some increases here. This looks like a high number. I think this might have been actuarial estimates that we plugged in from the actual report. And again, these numbers can change dependent on the direction that we get from the committee and the board as we determine a funding policy. This other pensions number includes IMRF, Social Security, Medicare. I think that's it. So that's a relatively small number. We're increasing over time. Services and commodities, we're anticipating somewhat modest increases over time. The debt service is based off of our existing debt schedule today and what we are planning for the current year bond issue. Obviously, depending on where capital recommendations come in and that associated financing plan, that would need to be adjusted according to projected bond payments to fund those items as well. So capital, both capital and community grants are listed as TBD. This is typically developed as part of the budget process as we determine available funding and potential financing needs. And the community grants are ultimately determined by the village board. So we'll be taking your direction from that in terms of what would be funded going forward. In terms of major expenditure trends on salaries and benefits, obviously salaries, we talked about this a little bit, salaries includes personnel costs for all full-time, part-time seasonal employees, talked a little bit about the bargaining agreements and the attrition factor. Overtime is subject to seasonal events and vacancies, so something to consider as we're heading into a year where we're holding several positions vacant. Sometimes that can be mitigated by seasonal events requiring overtime. Or in the case of public safety, if we have a situation where we have minimum staffing that we need to meet, overtime can kind of dig into some of that savings. We talked a little bit about pension contributions. So those are just things to keep in mind from a high level. At this point, before I get into next steps, are there any questions or comments or thoughts on what we reviewed so far?
Nikki,
I know that's a lot.
Nikki, can I just add
Sure.
a couple of short things, and then I promise to shut up. I think the struggle, as you look at some of these numbers and the struggle that we are working through ourselves at the very early stages of the budget development process, is trying to grapple with the unknown. And as we develop the calendar year 21 budget and look at reductions in expenditures, we want to be very mindful that some of those reductions may be unnecessary based upon revenues perhaps becoming more robust than they are, or they may be not enough, depending upon revenues further declining. And what we anticipate as you start to work with us through this budget process, this is obviously the very foundational conversation, is that we're probably going to have some changes along the way in the next few months that we otherwise might not have in a typical year. And so while Nikki has, I think, done a great job of having a first go at some of these numbers, what we do anticipate is that some of these numbers may change, and some of these numbers may change quite a bit, depending upon what happens in the next 2 to 3 months. She touched on it before. You know, if the state does not get the graduated income tax referendum passed in November, we will learn shortly thereafter what sort of impact we may be facing from that standpoint. The state has to some degree signaled that not succeeding in a referendum could mean significant changes in how their budget is structured, which translates into things like the income tax and how that might be impacted the local government distributive fund. So we are kind of eyes wide open on the fact that unfortunately we're not in a position like we normally would be in a moment like this to be as confident in these numbers today. And as we work through it, kind of the struggle that the staff will have is to create a budget that's reasonable and logical, and that has some alternatives available, levers to pull, if you will, for the village board to consider during the course of the fiscal year. And so these are a place to start, and we want your feedback, because your crystal ball, if it's more accurate than ours, we have no concerns and qualms about that. We're thrilled if that's the case. But this is an uncommon situation. We have really no data to look back to with almost a full economic shutdown for a period of time to help us predict what a future economic shutdown or variations thereof may mean. And so it's a difficult spot for all of us to be in. And as we talk through it in the coming few months, I think it's going to be a more iterative discussion than kind of the staff, the fully vetted staff recommendation that you're used to from a budget development standpoint. And with that, I'll get out of the way.
So, Nick, I'm not sure, Nikki, what would you like from us at this point?
Really just any questions or comments that you have on any of the assumptions, understanding that this is very early on in the process, and that a lot of these numbers may change as we head through. But I'm just looking for high level feedback if we're kind of on the right track, or if there's anything in here that you see that's alarming to you or that you're concerned about. Because this is kind of what we're going to build off of, to build a full financial forecast. And next month will be much more robust. It will be the full financial forecast. This is just kind of a high level where we're headed.
I mean, the only thing from my perspective, I think everything, it's kind of a guess. I would expect a lot of seasonality to sales tax.
Okay.
I mean, right now people are going to the restaurants and sitting outside, and that's not going to happen in November. And maybe some people are going to be going inside at that point, but have to figure, unless something changes dramatically with COVID, that's going to fall off.
Okay.
And with it, some of the businesses around the restaurants will probably drop too. So that was the only thing that sort of, straight lining an improvement when we do have a decent amount of sales tax coming from restaurants is probably, but that's the only, I mean, other than that, I don't know if anyone else has any input, but that was the only one I had.
Okay, thank you. That's a good point.
One other thing I would add that I think we as a board and a committee need to be focused on. Nikki talked about what happens if the increase in tax that the state asks for, the fair tax or the progressive income tax, whatever you want to call it, doesn't go through. On the other side of that, if it does go through, given everything going on, if you actually sit and spend any time looking at the budget with the legislature and the governor, it won't provide nearly enough money to fund what they're doing and what they've already approved as a budget. And so they haven't figured out how they're going to raise enough revenue to run the state, even if it passes. So we may go through and project everything out beautifully and be in the midst of having our budget, and then November occurs, and come December and January, we may find what they're doing is entirely different than what we thought they would be doing, irrespective of which way it goes. So we just have to be aware that this is going to be a very unusual year, and the budget we adopt will be just one form of budget subject to constant adjustment depending on what happens with COVID, what happens with the tax, and what happens with the state. I just mentioned that so that we remember that the staff is going to be doing lots of work and telling us a lot of things throughout. And this is the most uncertain period that we've gone through in many years.
And just so I'm clear though, when we talk about being flexible and all the changes that may be coming forward, we're going to keep the budget the same, correct? And then have, not alterations to the budget, but alterations to what we think is going to happen. I mean, we're not going to go back and change the budget each time, are we?
No, what we're going to do is what we've been doing. We had a budget.
No, just making sure.
Yeah.
Just adjust to whatever's happening.
To that point, Jonathan, I think it depends on the information that we receive before the budget is approved. So the expectation is that the budget will be before you for approval in December for a January 1 fiscal. I think to President Levin's point, if we learn something in November that may materially impact the budget that we have in front of us, there may be some changes that we have to apply.
Yeah, that makes total sense. I just mean once we're already into fiscal 2021, we're not changing anything.
We do kind of what we did this year. We may amend spending plans, but yeah.
Okay.
So then at least you can monitor where we started and where we're coming from. I think from a high level perspective, the thought process behind the budget to maintain flexibility, and Phil alluded to this earlier, was to prepare a budget with the best information that we have today, and then have, essentially a scenario of, if this happens, then these are the items that we can react with. And if this happens, and the building's on fire, then we're going to go to the horrible version or so on. But allow us to have several levels for the board to react if things don't go as what we planned.
And from President Levin, real quick, a question. So I just want to confirm something that you said, that let's say that they passed the fair tax, and that we can expect maybe that the outcome for the likes of villages like Glencoe is not so terrible. But I think I heard you say, Larry, that the state may still have such a need that it is not guaranteed that villages like Glencoe would see the revenues they might otherwise expect. So I just want to clarify if that's what I heard.
You heard me correctly, and what I was saying is, in discussing the budget, etc., the fair tax, if passed, and if the income tax they pass as a result of the amendment passing is what they've currently told everybody, that will still leave them with some major shortfalls in paying for the budget and making their contributions to their pension plan, to the teacher's pension plan and all of that. They have no idea at this moment how they're going to fill those gaps. One possibility that various legislative people are talking about is still taking away funds that normally would float us. So you have a governor who has said to us at one point, gee, if this passes, we can give you back more of the income tax we've been taking away from you. At the same time, three days later, everybody says, but of course, if things keep going the way they're going and revenues keep going the way they're going, we have no way to pay our bills, and therefore we may still need to take away PPRT, income tax, gasoline tax, all sorts of interesting things. And so we have to be aware that the legislature has not been able to spend enough time on the budget or talking to each other or any of the emergency committees to know how they're going to handle any of that. So there are ups and downs. Just because if it passed, you can't give a big sigh of relief and say, okay, there's going to be more money for us and everything's going to be fine. That's one selling point that's been used to try and get people to vote for it. In the actual halls of the legislature and in working with the governor, they have no idea if that's true. And they have reason to believe it isn't. And they are still trying to figure out what they're going to do, but they've been so thrown off by COVID They're just trying to be able to pay their bills till they get to the election.
Thank you.
You're welcome.
Trustee Bree, if I can go back to your question just briefly. One thing I do want to clarify is that from a statutory level, if we do find an expenditure that would exceed the budget, that would be something we would amend the budget for, just to make sure we have statutory authority. So I'm sure you know that. I just want to make sure that we're clear on that. So.
Yeah, please always tell me.
Perfect, thank you. Are there any other questions? Okay.
One other thing that I'd point to with capital, we'll be talking about CIP with you guys in October, I believe. We are going to, as we've mentioned, need to look at the items that we deferred from the current fiscal year and how that overlays into the upcoming fiscal years. We also have before you on Thursday night some question of the perhaps next steps or not relative to the subject of our governance model. Some of that may have ramifications on what our long-range financial planning may look like as well. For instance, we do in the debt schedule that you all saw and that was integrated into the current fiscal year's budget. We have a bond issue next year, which was foreseen as a potential referendum question. We're going to have to probably make some decisions before the end of the calendar year as to whether or not a referendum question on a bond sale or a referendum question perhaps on home rule authority or some other referendum question may need to be brought forward in 2021, understanding that the only elections in 2021 are the local primaries in February and the municipal elections in April. So just something else for you to keep kind of tucked into the folds of your brain. We'll be talking about that and trying to come back with a reasonable way forward, realizing there's going to be capital needs regardless of how COVID changes our projections and how do we try to manage within that. So we'll be burning some midnight oil and trying to figure that out as well.
I might mention, as you think about what goes on tonight, you will understand why we're getting a lot more tax from Binny's.
Yes, Binny's is doing well.
All right, are there any other questions or comments? Okay.
So we could just hang out for a while and just.
Yeah. Any other business anyone wants to bring up?
You guys want to go home?
If nothing, Jordan, were there any public comments that came during the meeting?
Trustee Vree, we did not receive any public comment tonight.
All right, can I have a motion to adjourn?
So moved.
Second.
All in favor?
Aye.
All right, we're adjourned.
Aye.
Thank you.
Good
night.
Have a good night.
Yeah.